Hello and welcome back to day 2 of Aditya Birla Sun Life Mutual Fund presents Voyage 2020 Navigating to a Better Tomorrow, partnered by ET Now. Now, this year, owing to the circumstances on hand, Voyage has gone digital, but our core stays the same. This year, too, we're bringing you the most knowledgeable and experienced speakers as we focus on the theme Navigating to a Better Tomorrow. Yesterday was a great day. We got some amazing insights. We started with market expert Vallabh Bansali, who gave his thoughts on the industry, the way ahead. We were also joined by Vinod Bhatt of Aditya Birla Sun Life AMC, who shared his thoughts on the role of fund of funds in a quest for stable alpha. Then we had the president and CEO of Sun Life Financials Canada, Dean Connor, who was in conversation with Aditya Birla Sun Life AMC's MD and CEO, A. Balasubramanian, and he shared lessons from legacy, followed by some of the biggest mutual fund distributors and IFAs who spoke about their thoughts on how to pick the right fund house and the science behind scheme selection. All right, today as well, we have a stellar lineup for you with acclaimed author and global thought leader, Dr. Nassim Nicholas Taleb, joining us in a short while. But before we kick off the day, just a reminder, as always, Voyage 2020 is an interactive event, and we want you to keep sharing your comments, your thoughts, your suggestions. You can do that both through the chat window in the webinar software, as well as you can put it out on social media. You can use the hashtag Voyage 2020 and also tag us at @ABCAVSLMF. All right, then, let's dive straight into our first session today. Now, the stock market volatility over the past few months has seen most of the investors running around like headless chickens. Some have sold off their holdings or have redeemed their mutual fund units, while others have bought aggressively during the market dips. But what is the approach towards equity for a leading AMC? To find that out, we're being joined by the CIO Equity Investments at Aditya Birla Sun Life AMC, Mahesh Patil, and he will be in conversation with the founder and CEO of Value Research, Dhirendra Kumar, about portfolio strategies for a post-COVID-19 era. With that, it's over to you, Mr. Dhirendra Kumar.
Thank you, Sumit. I hardly need to tell you that we are living in extreme times, and we are getting extreme predictions. And in fact, the more the kind of times we are living in, the social media, which has become the mainstay now, our primary source of opinion, news, information. More extreme views on each side, on all dimensions, seems to be gaining more attention. Of course, it's the most extreme times we have seen in our lives, and I'm here with my set of questions for Mahesh. In normal times, I ask him, "What are you doing? What to expect?" and all that. Of course, those are perennial questions. I'll have those questions too. But this is a very unusual time. So I have just listed a set of questions, which makes me wonder that, are we going to be in a completely different world? So without wasting much time on the introduction and anything, I'll just get started. Thank you, Mahesh, and welcome. I have a lineup of 10 to 12 questions for you. And one is that the spread of COVID-19 has deepened in the country. We are getting an extension of the lockdown every other day. And we are waiting patiently for the Prime Minister's announcement. He's setting up an appointment with us in one evening and giving us a roadmap. How unusual is this? How unusual is the sustained recovery of the markets? Because market is going in a completely different direction. What is happening? The real situation in the market. What we see in the world around us is completely different from what is happening in the market. So what is driving it? What do we make out of it?
Yeah, let me wish all our viewers a good evening. And so just to take back in perspective, at the beginning of this calendar year, things were looking fairly good, right? For the global economy was recovering. We have seen that the global risk appetite was coming back. And in general, the huge liquidity which was there globally was supposed to take the markets and economy higher. And so getting into this, when COVID first broke out news in China, people thought it was going to be limited to China and nobody thought that it will spread all over the world. But as the pandemic started to grow in proportion and moved from China to Asia, then to Europe, USA, India, we saw that people, the market started to take note of it and started to wonder whether it's a very serious pandemic. And that's where I think suddenly at that point in time, until then, I think the market was fairly complacent. There was low volatility. And in the last couple of years, we've seen a huge amount of money going into bond funds. Then there are these risk-adjusted funds which are there, which play on walls. So there was a lot of leverage which was there. And suddenly when this thing broke out, we saw a panic selling which was there. And a lot of these bond funds and risk parity funds, as they call it, they started to unwind. And the selling was ferocious. I mean, we saw in a matter of 2-3 weeks, the market corrected by almost 35 to 40% across the world. And that led to the initial sharp reaction. And in India also, we saw that there was $8 billion of outflow in the month of March. So that was the initial reaction. Then I think this time around, I think
what we saw in the March,
what we saw in the month of March, yes. And so this time around, I think unlike during the same, we saw a crisis which was the last we remember is the global financial crisis, right? When the markets corrected sharply. So that point in time, after the Lehman crisis, it took some time for the central banks to come in and come with the policy response. But this time around, with hindsight in mind, we saw the central banks globally, whether it's the Fed, the ECB, the Bank of Japan, everybody reacted pretty quickly and announced a stimulus package. US cut interest rates down to 0, and huge liquidity was infused. Also, the governments globally came into action mode and decided to announce a large fiscal stimulus package. I mean, the fiscal stimulus package, most of the countries have announced a tune of around 8 to 12% of GDP, which is almost twice what we had in the global financial crisis. So I think the response was pretty swift. And as a result, the market rebounded from those lows, and we saw almost 50% retracement of the fall. Typically, that's what happens, okay, when you see a large sharp fall, market rebounds. And then during that period also, what happened was there's been discovery across the world. People are trying to find a solution for this disease. And there were a couple of companies, one company in US called Gilead, which announced that they are working on an antiviral drug, remdesivir, which is found to be effective against COVID patients who are terminally ill. It reduces their mortality rate. And that gave a hope that probably you would have some kind of a remedy coming in soon. And there were various other combination drugs which were talked about, like HCQS and azithromycin. So all that led to a hope rally in the market, and that's the reason why we saw the market rally about around 25% or so from the bottom. Having said that, I think that's what happens. There's initial bounce back, then reality sets in. Okay, you take stock of the situation, how things are in the economy, and then market takes its normal course.
What, in your opinion, looks like this can linger? This is a crisis which has, is disease, and its impact can linger, and and it can linger for months. It can linger for years. So, how bad can things get for the economy? Because right now, just liquidity, which has been, introduced in the, has been reinforced, but the world has come to a standstill. So, in that sense, how bad things can get for the economy?
So this is a crisis, I think, which we've not seen before, I think, in our lifetime. and it's virtually, as you rightly said, it's the economy coming to a standstill, right? Both on the supply side issues as well as demand side disruption. And the impact on the economy in the near term period is very, very severe. And so we've seen every business, every industry is getting impacted because of this lockdown. Because the only solution to tackle this virus is social distancing and lockdown, right? There is no other way. So that is, except for a couple of sectors like pharmaceutical, basic consumer utilities, telecom, everything is getting impacted.
Yeah.
And that will take its toll on the economy. We are seeing the estimates which came in initially. Initially, one thought that the impact would not be that much. You will see a soon recovery, a V-shaped recovery. But as we got to know the virus much better, the way it's spreading, and the mortality rate, and the lockdowns are getting extended, I think there has been a significant cut in the growth estimates. So just to give a number over there, globally, we were looking at this year, the global GDP was supposed to grow at around 3.1%. That number is now being cut anywhere between -3 to -4%.
Mm-hmm.
That's the kind of a cut we are looking at. In India too, I think we were looking at a GDP growth in FY21 to be around 6% or 5.5 to 6%. That number now, if you look at a couple of the economists which have reported numbers, they're anywhere between -1 to -3% in that range. That's a kind of a deep cut in the economic growth. We haven't seen that in India, kind of a decline even during the global financial crisis.
From a growth economy to a shrinking economy.
Yeah, yeah. And it will be, I mean, this quarter will be very bad. The growth rate could be around 15 to 20% lower. As we come out of the lockdown, slowly things will start to come to normalcy, but we'll start be back to normal. Second quarter, okay, it will still be negative, probably 10%. Third quarter, mild negative. And fourth quarter is where I think we can expect things to start to come back, okay, in positive territory.
Mm-hmm.
That's the kind of situation we are currently looking at.
It all comes with a rider that how things shape up from here on.
Sure. I mean, we have to take it as we go, right?
Yeah, so you have been a professional investor for a long time. You have interacted with businesses, met them, understood their business, and the kind of life we have lived in the last 7-8 weeks. It's a complete change of the way we have lived ever, and unlikely will live ever in future, or maybe things change. So do you think it's going to do you think structural change in the way the businesses are run, or the service component of the businesses, or India being a service economy dominantly, any structural way which you visualize that businesses will change forever?
I think whenever we come out from any crisis, I think we come out a bit different. I think there are changes which happen both in the industry also, and in terms of how we conduct things. I mean, this is kind of a event, okay, where we see a lot of social changes which will happen, and that will impact the way we do businesses, okay, how we conduct ourselves. Prominent changes what we see is because of social distancing, I think we have adopted to working from home as a compulsion, and slowly and steadily, I think it will become a way of life, right? And we realize that one can continue to work from home with the same amount of productivity in a lot of sectors and services without actually getting impaired. I mean, like in our case, right? We are working totally from home, and there has not been any problem in terms of our efficiency. Mm-hmm. And I think that will continue. And in fact, a couple of companies like Twitter recently said that they will ask 100% of the employees to work from home for this period. And each company will try to calibrate and see, okay, how much the employees can work from home. Like IT companies, TCS has said that they would look at around 40 to 50% of the employees working from home. And that would mean not only for companies in terms of trying to cut down on their costs, and also productivity could go up because the travel time, and especially metro and this is much larger. Mm-hmm. But when you're working from home also means that there's a kind of changes which you will have in your lifestyle, right? So there will be demand for a lot of home improvement products, okay, which could be there. You will probably want your home to be air conditioned if it is not. So demand for some of these things could go up. Also, people are starting to become much more independent, right? Self-reliant. I mean, you don't have your mates and others. So you need to have other devices, okay, at your home, okay, which will improve your efficiency. So demand for basic consumer goods, consumables, whether it's a washing machine or other home appliances, I think you could see a demand for that go up. So that's one kind of change which we see. Also, I think coming out of this, I think social distancing will continue to be there because the virus will be prevalent. And and people will be really worried in terms of getting into crowded places, malls, multiplexes. So I think the way we go out and have our food, entertain, I think that would also change. And I think we saw a pickup of shared mobility, right? Ola, Uber, okay, that was the trend. I think you could see a reversal of that in some way, as people who want to have their own vehicles and want to avoid public transport. So the demand for own vehicle, whoever can afford, could go up for two-wheelers. But the bigger change I see is on the digital side, right? Because everybody is now working home, trying to adopt digital, and a lot of businesses have been forced to do it or are doing it out of choice, and companies which are able to adopt digital as a part of their business. Okay? It's not only for on the operation side, but is also on the supply side, supply chain side, as well as on the front end in terms of customer acquisition. I think they would be able to differentiate much better and be able to come out much stronger. So these are some of the changes, okay, which we see. Also, I think people have, after all this, I think the demand for protection will go up, right? When you see this, so you would see demand for insurance, right? Whether it is life insurance, health insurance, and general insurance, I think that would also increase.
Day before yesterday, our Prime Minister announced that big headline stimulus, which is 20 lakh crore. It is unprecedented. We have never heard of anything of that kind. And yesterday, and it is still being announced. It is underway. While we talk, the second conversation from the finance minister will be on. Yesterday, we got the first tranche of it. And even before RBI took some initiative. And let's see how things evolve. But do you think, this is good enough based on what we saw yesterday?
So, like stimulus, I mean, looking at the crisis, okay, and the kind of a slowdown, what we're looking at, and not knowing, okay, how long it will take us to recover. I think any kind of a package would look small, but I think what the finance minister and the prime minister have put out together is a decent package. If you look at it's comparable to some of the large packages which some of the global economies have announced. And, we have seen first tranche of that come in early on, okay, which was trying to address at the bottom of the pyramid, trying to send money at the hands of the poor, the rural population. Then we saw a lot of liquidity measures taken by RBI, which were announced, and the package which was announced yesterday tried to address the problem of the medium and small enterprises, right, which are going to be at the forefront, okay, at the front, both in terms of their businesses, in terms of liquidity. So up till now, we have seen total of the 20 trillion rupees of package, which is 10% of GDP, around 14% has been announced. And the MSME package, okay, which provides a credit guarantee to around 3 lakh crores of loans, okay, which can be disbursed to MSME sector, which is pretty substantial. It accounts for almost 15 to 20% of the total MSME credit, which is able to ride them for the next.
Quite significant,
right? And to that extent, it helps to avert the problem in the banking and financial services and the NBFC sector in terms of NPAs. So that, I think, to a large extent gets addressed. Also providing liquidity to the NBFC sector. So I think this is the first one. I think and the good thing is that while this doesn't have too much of a fiscal impact, right? The total cost of this is just around 80 basis points. But I think the second tranche of the package, which will get announced today or in the next couple of days, has to be really addressed towards stimulating demand. Right? Incomes are going to get impacted because of this crisis. So you have provided liquidity and survival, but you also have to take care of that. And demand stimulus in terms of trying to direct benefit transfer or cash transfer to sections of the economy which are getting directly impacted. Is in budgetary allocations towards, say, the housing sector or the infrastructure sector to boost demand. Those are the measures, I think, which one would like to see, which could be actually hard for fiscal stimulus and which could probably be another 2% of GDP.
Okay. You did highlight some of the changes that will come about, and we are in the middle of this big economic pain with the economy on a standstill for so long. But what kind of specific opportunity that you are looking at? Every pain comes with some opportunities getting created. You listed some of them. Can you elaborate more on that?
So the opportunities, okay, can be one is I think for a country as a whole, I think it's going to be, I mean, as the Prime Minister mentioned, right? Every crisis can be an opportunity and how you take it. So I think what I'm more looking for, besides the fiscal stimulus package, okay, what kind of a reforms come in? Because I think we'll come out of this crisis over the next 1 year or so, but going into that for long-term sustainable growth, I think if you're able to take this adversity, and that's what the Prime Minister said, and if you're able to usher in a new phase of reforms, I think then the long-term sustainable growth of India looks much better. I think the finance minister hinted at reforms in the land and labor right area, which is pretty significant. I think what opportunity is coming in for India is that we want to be self-reliant, right? So PM talked about Atmanirbhar Bharat. So it's not only import substitution, but I think what has happened in China, the trade wars and post-COVID, a lot of global manufacturers are trying to diversify their supply chain from China into other countries. And for India, it's a big opportunity. If they're able to attract some of the large investments over here, then I think that can provide us another fillip of growth to our overall GDP.
Huge economic growth that can.
Yeah, I think that is, I think, something which is a big opportunity. Already, I think bulk of the measures have been done in the last 5 years. We have seen the ease of doing business going up, right? We have seen the tax rate being brought down to 15% for new manufacturing. So that is fairly attractive. On the logistics side, also a lot of improvement has happened in terms of the rail, road infrastructure. The dedicated freight corridor will be commissioned in a year's time. So what was remaining was only reforms on the software issues like land and labor. And then also we've seen some of the states like UP and Madhya Pradesh have recently come out with notification where they have said that the archaic labor laws need not be adhered to for new companies which are wanting to establish over the next 3 years. So I think if you're able to really crystallize this and identify a few sectors, okay, be it in areas like chemicals, it could be in textiles, it could be in consumer electronics, in IT, in pharma, okay, for manufacturing of basic raw materials. I think that can be a big opportunity for India, which can create a long-term growth driver for our economy.
Manufacturing economy getting a big boost.
So that's I think from a country, that's a big opportunity, okay, which one is looking at. As a portfolio manager, right? I think the opportunity is, I think, in this kind of environment, clearly the companies which are having a strong balance sheet, which are much focused onto their businesses, have got a strong competitive advantage. I think they will continue to become stronger and bigger. Companies with leverage, whose cost structures are much higher, will get squeezed out in this environment, and some of them will perish. Some of them will barely survive. So some of these stronger companies with strong brands, strong.
That's the broad framework you're operating in. That stronger balance sheet is something to go with.
Stronger balance sheet, stronger competitive advantage, cost advantage, stronger brand. I think
advantage. Okay.
These will be the companies, okay, which will survive. And that will be across sectors, right? I mean, sector-wise, there will always be various sectors, okay, which could look better. But I think that could be a broader theme which we would like to adopt.
You know what? We are in the middle of this crisis, and we don't know the time frame. We don't know the pace of reversal back to normalcy. What kind of time frame, with what kind of damage, with what kind of uncertainty in terms of labor or the kind of state or the production base where it is. With that in mind, how do you actually
viewers, please wait. I think there is some disruption. We are waiting for Dhirendra to come online.
Hi, Mahesh.
Hi, Sweet.
I think Mr. Kumar's internet was an issue, but of course he'll be joining us back very shortly. Just so I was getting part of the conversation.
Yeah.
Okay, I think he's coming back, but just yeah, he's coming back. He's come back, so that's good. I was just gonna throw in a question of mine also, but the idea is, of course, that everybody is really worried. So the main thing is like, how do you calm people down? I think Mr. Kumar is also back. So, Mr.
Sorry
Kumar,
for the disconnection. We are living in a completely new world, and but we are just gearing up for it. I had a backup on which I could move to, and
so I'll hand it over back to you, sir. So over to you again, sir.
Thank you. So Mahesh, just talking about where do you derive your conviction from, with so many variables being completely uncertain?
You're right. I mean, we are in a period where there's a lot of uncertainty. We don't know how the virus spread will be, whether there will be a double dip, which could be there. So I think in this kind of an environment, it's while we keep on looking at the day-to-day changes and tracking the near term, I think one has to look slightly beyond this. Which are the sectors, which are the companies which will come out of this stronger? I think that clarity has to be there, and I think, as I mentioned earlier, within sectors there will be winners, which will be able to navigate this situation much better. They have a stronger balance sheet. They have the right management, which will be able to address issues. And yeah, I mean, couple of quarters, will be bad. That is a given. But coming out of this, which companies will be strong? I think it will be much more stock specific, is what we are looking at. At the same time, which are the sectors which will start to emerge first coming out of the lockdown, right? There are certain sectors, which on the consumer side, which will come back much earlier. So that could be one of the sectors which we'll be looking at. Apart from that, other sectors where social mobility, will restrain people from going, like in malls, theaters, they will take a longer time to come to. So I think it will be a more calibrated approach across sectors, how normalcy will be. But I think apart from that, it's clearly the same companies, stronger companies will again come back, and one needs to actually wait for the right opportunity, to buy these. I think the crisis is providing us opportunity to buy good companies at a reasonable valuation.
At a reasonable valuation.
Yeah, and that's what I think we are trying to identify in this environment.
So validating all your hypotheses now in terms of what will, but with all the uncertainty. Now, the way you have functioned in the past, like getting up in the morning, get ready to reach office, have your morning meeting and decide what to buy. Of course, all those routine would have undergone a change. But is there a fundamental change in the way you manage your funds? Have you started asking loudly some key questions which you never used to ask? And what are the results of, what is the result on your, what are these key changes translating into changes in your portfolios?
I think even before this, right, we were looking at our whole investment process. What are the changes, we need to do? Mm-hmm. And more so after this crisis, I think some of these things are being crystallized. So every crisis, I think, gives us an opportunity to look into our processes and see what needs to be strengthened. We did that after the global financial crisis. We in 2010-11, we strengthened a lot of our investment processes around stock idea identification, construction, around risk management, and that helped us in the next 8 to 10 years, and we've seen that improvement across all our funds. I think getting into this crisis, also we had a tough year, last couple of years, and that enabled us to really look into some of our processes and look at where we need to strengthen. And while doing that, we came up about a couple of action points. A, when you are and doing stock identification, when we are evaluating a company, normally we would look by the numbers, right, which is important, okay, earnings. But I think we sometimes miss the trees for the forest, right? So we need to really get the narrative part for a company well, because we missed stocks in the last 2 3 years. Many companies which were good companies, but we missed them because the valuations continue to expand. We've seen a few sectors or a few new generation high growth sectors where the multiples were very high. And that was a problem with our philosophy of growth at a reasonable price. So we thought, okay, let's have a narrative for a company where we ask questions, right? What is the right to win for this company, right? What is it, key thing which will drive this company, not in the shorter term, but in the longer term? How will it continue to grow faster than the industry? And getting the narrative right is important for us to really back a company, not just looking at pure numbers. So we started doing that for each and every company in our investment universe. Other thing what we see is during
Has it translated into a substantial pruning of your portfolio?
Yeah, so that's the next step, okay, which came in that once you start to really focus, because in the last few years, we had seen our investment universe had kind of expanded quite a bit, right? We got a lot of companies because the market was growing, but then we realized that, okay, we need to probably get much more focused. And once you start to filter your stocks through all these filters, okay, then the investment universe comes down. So we have consolidated our investment universe significantly to bring in a sharper focus. And what we realized in the last few years, and especially after the NBFC crisis, management quality, and during those times, we saw a lot of companies with poor corporate governance or management issues were suffered quite a bit. And that's when we tried to build some management evaluation framework in terms of our overall stock selection process. Management, and we've seen in the last few years, markets are willing to pay a premium for good quality management. And management is what really drives the company from a long-term perspective. So build a strong framework in terms of how to evaluate management, both qualitative as well as quantitative factors, and brought it as a part of the investment process. That is something which is one more dimensions, okay, which we are using while evaluating a company. And we've tried to build in a slightly longer term focus for looking at companies, especially high growth companies. So it's important to visualize not just the next 1 or 2 years, kind of, but next 5 years. Okay, what is likely to be the growth and how the market opportunity will grow. And that has enabled us to identify companies which are very early stage of their growth cycle. Which might, some of these stocks could be in the retail sector where they might look very expensive and we would have avoided that earlier. But we have a better framework to now look at these high growth early stage companies as a part of our investment universe. So these are some of these changes. And besides that, we have strengthened our risk management framework. We have also overall at the portfolio level, also we have consolidated our holdings. So we have seen that our portfolios, the number of stocks had gone up. And last couple of years, the market breadth was very, very narrow, and that hurt us. And then we looked at what is the right number of diversification is required in a portfolio, right? And that led us to tune down some of our holdings in the portfolio and brings. We don't want to run a very concentrated portfolio. We want to maintain diversification because that's again a part of the risk mitigation strategy. But clearly, there was room to
not to diversify
in the portfolio. So these are some of the changes and learnings, okay, which we have incorporated in our thing. And that
looking at your, sorry, Mahesh, I was looking at your the portfolio of the focused fund, and it has 10 to 12% cash. Is it a tactical or opportunistic? Is it meant for tactical or an opportunistic buying right now?
So I think in this current environment, when there is uncertainty and we expect the market to remain volatile in the near term because we still don't know how the virus curve, especially in India, is still not peaked out. It's good to have some amount of liquidity at hand. That gives you opportunity because we see these sharp corrections in the market, and stock prices tend to fall much faster, and it gives you opportunity to buy stock at a very attractive price. Also, the focus fund is a more concentrated fund, okay, where the stock concentration is much larger, and that makes it much more volatile and much more riskier.
Other funds may not have this larger cash allocation.
Yeah, so other funds would also have, but not to that extent what we have in the focus fund. So it's more of a tactical short-term strategy for us to manage the current uncertainty and take advantage of opportunities, okay, as they come in.
We are in the middle of this crisis, and it might be a little premature to talk about, the turning point of this crisis. But every time every turning point, we see that, sector leadership changes after a major crisis or after a major inflection point for the economy, for the market. After the global financial crisis, BFSI or, consumer-led rally, whatever we saw. So, the market leadership of the companies, of the leading sectors, what was driving that, the market before changes. What do you think will be the big change this time?
So I think you're right. I think every decade we see some of the new sector emerges. Last year it was, in the last decade, it was to some extent the banking and financial services sector where we saw its weightage increasing, almost doubling over the last 10 years. Then there was quality and consumer sectors which came up. I think this crisis would also lead to some changes in the next decade. As I said, this will be totally different, right? As I mentioned, it might not be sector specific, while there are a few sectors, okay, which we think will do well for the medium term. For example, pharma is a sector where we are positive, and the sector has underperformed in the last 3 years. Domestic pharma is doing well. Government focus on healthcare, insurance would mean that you see a long-term sustainable growth on the domestic pharma side. And Indian companies have also really transitioned on the US side from generics getting into complex generics. So I think that will provide an opportunity again in this environment. This is a sector which is the least impacted. That sector looks good. Then again, consumption, I think in India will going to be a long-term story because of the demographics, right? And especially low-ticket consumption, right, where the penetration levels are still very low, and as per capita incomes go up, as we see the electrification in villages goes up, the desire to buy consumer durables and other items will go up. So that's another area where we see long-term structural growth. Near-term, the consumption could get impacted, but I think as things normalize, and also government is trying to put money at the hands of the bottom of the pyramid, right, where there is a propensity to consume more, especially for these small-ticket discretionary items. That's a longer-term theme which will continue to do well. Apart from that, I think the banking and financial services sector would also do well. I think there will be some shifts there. Probably you would see the insurance and other sectors which are non-balance sheet led. I think you would see stronger growth. Again, penetration levels are much lower over there. So that could be another sector which could emerge within the banking and financial services sector. And I think other areas which are some smaller sectors, right? For example, chemicals and other areas where India is now, again, what's happening in China in terms of moving off a lot of supply chain over there. And Indian companies have got the expertise in terms of chemistry. So I think that could be another sector, okay, which could emerge. But I think going across sectors, I think it will be important to see going forward. I think within sectors, there will be companies which will adapt much better, right, to the changing environment as we discussed. I think what are the changes, what we're seeing, environment, who will adopt technology better, right, who will to redefine their businesses. That disruption is happening across sectors, whether it's in the retail sector, whether it's in the media sector, whether it's in the banking sector, right? So companies will be able to adopt that change, okay, adopt digital as a way of life, are able to use data, right, effectively, okay, to mine data and to do analytics on that to understand consumer behavior and target, and specific consumer needs.
More precisely.
Those are the companies I think which would emerge the leaders going forward. So it's going to be a mix, across sectors. I think some of these companies which are going to transcend this change, as well as some of these other sectors, which could be the next drivers of the rally going forward.
Companies which adapt better will do well. Okay.
Yes.
Given all this, what should be an investor's expectation from equity funds near term, which is within the next 1 year, and next 5 years? Interest rates have come down to where they are now. So what should be an investor's expectation over the next 5 years and 1 year?
So I think from a near-term perspective, clearly, I think markets we think will remain volatile. We've seen the markets move up, after the initial correction. We are still not out of the woods. We're still seeing the curve, the virus curve, what happens after the lockdown, whether we have a next wave. So that will keep the market in tenterhooks, and you will see ups and downs in the market. But clearly, I think, and again, because of the sharp impact on the economy, we are seeing a sharp cut in earnings also. So this year, the Nifty earnings growth, which was initially expected to grow at around 20-22%, is now being cut. And the consensus is now at around minus 4 to 5%, but we could probably see more cuts over there. Mm-hmm. So virtually, we are going 1 year behind, right, in terms of growth. But again,
1 year is a write-off for us.
Yeah, in a way, right? Yeah. And to some extent, some of the demand will get deferred, into going forward. A lot of consumption demand, especially for discretionary, will get deferred. So you could see a bounce back in FY22. But clearly, I think we are seeing significant cut in earnings. And post that, I think in an environment where there is uncertainty, it's best to look at the trailing earnings, right? Mm-hmm. So CFAL and price to book value and other parameters of valuation become very important. So after the correction, and especially when the markets corrected back all the way to 7,500, we reached a valuation on the price to book value and market cap to GDP, which was kind of an all-time low, right? What we saw during the global financial crisis. So clearly at that level, the market was looking very, very attractive from a longer-term perspective. And we've seen whenever anybody buys at those valuations, the returns in the next 2 to 3 years are much larger than the long-term average. Mm-hmm. However, we have now bounced back from those levels. We have seen a 20% move. And currently, the market valuation, the price to book value, is still attractive. On the PE multiple, we are now closer to around, if I look at the trailing earnings, we are around 5-6% lower than the long-term average. So maybe our starting point is attractive in terms of valuation. And going forward, if you write off this year, I think the long-term growth as we come out of this crisis, and if India is able to take advantage of the situation and reforms, I think we can again come back to our growth rate, long-term growth rate, which is around 5.5-6% or so. That would mean that earnings, for the market also would be somewhere in long-term average. So I think in this context, I would expect that the market valuations are reasonable, slightly attractive. Long-term, I think you can expect returns to be around 12-13% from these levels. In the near term, I think the market will remain a bit volatile. So I think that's how I think we would look at. I think investors coming in at these levels would advise to spread out their investments over the next 3 to 6 months. Is looking at the volatility, but clearly this is the time to start increasing the equity allocation.
Mm-hmm. Getting back to the most important question, that what is the asset allocation? If you have, of course, this is a traditional question, but these are extreme times, So if somebody has all the money right now, and if he has to spread his money around in terms of equity, debt, which kind of equity, which kind of debt, wherever, how will you spread your investment? Assuming that it is your long-term portfolio and you have your money to spread, how will you allocate it?
So I think as I mentioned earlier, the market valuations are slightly attractive. The starting point is good. So one would have a slight bias towards equity, right? So your asset allocation equity, typically you are having 50% debt, 50% equity, I would say one can increase the allocation slightly. And if the markets from here, one can increase that further. Within equity, I think that clearly the bias would be towards a large cap fund. I would say because at this point in time, we've seen a decent correction in the large cap stocks, okay, which had continued rally for the last 2 years, and provide much more stability to the blue chip companies, and the resilience power is much more better. And so a larger allocation to a large cap fund than a multi cap fund. So I think large cap and multi cap can be around 75% of the allocation. They could 15% allocation to mid and small cap. The mid and small cap will remain uncertain from a short-term perspective, but the valuations there are fairly attractive. The mid cap index is at a 6-year low, and long-term investors, this is the time to build some exposure over there. 50% allocation can be a thematic fund, okay, which can be fund like a banking, the pharma and the healthcare fund, which launched around 9 months back. It can be a consumption fund like Gendex fund of ours, or it can be an MNC fund, or even banking and financial services fund in the next 3 months. I think during the crisis, whenever we have bought this sector, it has done good returns.
I was expecting a slightly more precise thing, because if I have to do all that, I would rather go for your frontline equity fund.
I mean, what can always come in through the asset allocation fund, right? We have an asset allocation fund which does the asset allocation across asset classes and within the category. And for investors who are slightly averse of volatility, they can look at the balance part of the balance advantage fund, right, where the equity allocation changes dynamically.
Does investing in international equity make sense? While the whole market, Indian market collapsed, we saw a far greater resilience there. And how upbeat are you about that? And
so in fact, investing in international equities has been rewarding in the last 10 years. It's given almost 3-4% higher returns in the domestic market. And that's not suggesting that going forward we'll continue to do that. But it just shows us that investing international markets as a diversification, I think makes a lot of sense, especially investors who already have a large exposure of domestic equities. But also for somebody to participate in a lot of sectors where you can't invest in India. Okay, these are in areas of technology, some of the new generation companies, which is happening. Even from a portfolio perspective, also we are looking at few of the international stocks. So we did some experiment in our dividend fund. In India, we are finding difficulties finding high dividend stocks.
So all the mainstream fund are finding, these international stocks are finding a way in there.
Yes.
Okay. Thank you very much. I'm being given a notice that it's time to close now, and Mr. Talib is trying to connect. So I look forward to listening to him. And thank you very much, Mahesh, for sharing your perspective.
Thank you.
Well, thank you for that, Mr. Patil and Mr. Kumar. Now, monitoring global and domestic outlook is obviously important, but it is also extremely important to know what's happening on the ground in certain key sectors. So our next panel discussion will have sector analysts from Aditya Birla Sun Life AMC sharing their bearings of the Indian economy and the Indian industry. They will be in conversation with ET Now's Aisha Faridi. Allow me to introduce her panelists, Dhaval Shah, Chanchal Khandelwal, and Dhaval Gala, all sector analysts with Aditya Birla Sun Life AMC. With that, it's over to you, Aisha.
Thank you so much for that, Sumit. For years, we've been associated at ET Now with Voyage 2020, but this is the first, the digital edition of Voyage. So welcome to all our participants, and of course, welcome to all our attendees as well who are logging into this webinar right now. And with that, let me also welcome my panelists. Today, I have with me Chanchal, who tracks FMCG, consumer durables, as well as the retail sectors, as also manages the Birla Gen Next Fund. I also have with me two Dhavals today. today, Dhaval Shah. He tracks pharmaceuticals, healthcare, diagnostics, and also runs the Pharma Fund at Birla. And Dhaval Gala, who tracks the BFSI, banking, insurance, and NBFC sector. Gentlemen, afternoon. Good to see all of you. Dhaval Shah, I must point out here, let me start the discussion with you first. Given that you track one of the hottest sectors right now, pharmaceuticals, that's clearly the flavor of the season. Let's begin by talking about the first pillar of growth here, revival in exports. After 2 years, Dhaval, of a decline, FY20 was pegged to be the year of consolidation and thereafter finally witnessed growth. Now with this sudden, rush around finding a COVID vaccine, where do we stand in this journey?
Sure. So, let's take for a moment COVID out of the equation and understand, how the sector was panning out over the last few years. So if I look at a 10-year journey for this sector, it has actually gone up from being a $9 billion industry, and I'm only talking of pharmaceuticals and not healthcare combined, to today a size of around $38 billion. So, it's been 4x from 2008 till now as a sector that we are trying to look at. Within that, the first 7 years was gun blazing. Domestic was growing at 12 to 14% and exports was growing at around 25% kind of a CAGR. Last 3 years have been difficult years for export business. And as you rightly pointed out, 2 years have seen a decline in exports. Now, what are the reasons because of which that actually happened? First, in the largest market for exports, which is US, there was massive customer consolidation. From earlier 7 to 8 buyers, the number of buyers got reduced to 3 because of mergers and acquisitions between themselves. And that is where there was a lot of pricing pressure, which actually happened for various pharma companies catering to that market. And secondly, there was a lot of plant issues which were there with companies, within India, because of which they were either receiving an, OAI or a warning letter or, an import alert in extreme cases, because of which product approvals were getting delayed. Now, last 1 year, or rather 18 months, many of the plants which were having some kind of an, approval lag were all coming on stream, and, slowly and gradually plant approvals were gaining stream. And that is where, last year we called out that this year could be a year of consolidation. And from next year, we are looking at growth. If we look at strictly the trends, within the export pie, what were we expecting is companies which are catering to complex generics or respiratory, or specialty should actually gain traction from here on. Now let's bring COVID into the equation and see what has happened. Incidentally, COVID has, helped in terms of expediting a lot of plant approvals on ground. So a lot of companies today are, announcing over the last many weeks that they've actually got that US FDA plant approvals, which are stuck up for quite some time. And at the same time, some of the companies have also got product approvals, which were meaningful in nature. So I think COVID-19 has, provided an impetus, and, that should add to the overall growth phenomenon that we are trying to look at. So at the same breath, if I were to say that, how is the overall outlook looking like? We actually called out last year that the $38 billion industry by 2030 will become a $100 billion industry by 2030. And that is something that, we have far more confidence today that, we are on a right track to actually achieve that.
Sure. Get you in over here. Does it, feel that when it comes to consumption as a space, just about everything is going to change right now? Or actually consumer-facing NBFCs, is there bound to be more fear and risk perception as seems to be building into stock prices, even for some of the leading names right now?
So, if you look at NBFC companies, right, most of the NBFCs in the country have been retail-oriented and focusing on acquiring customers more, which banks have not been able to cater to or reach. So definitely market will differentiate among better run NBFCs and one facing structural challenges, whether it is wholesale real estate or stuff like that. But companies with strong parentage, better corporate governance would tend to come back. That's the first thing. Market stock prices do tend to be volatile. Today, the environment, whether it comes to liquidity, whether it comes to macro, whether it comes to post-COVID and how will things navigate from here are not clear. So we will not be right to understand which companies may go down under and may not survive. But with companies with strong parentage, corporate governance should come back fairly well. If you ask me, how do we look at NBFC companies and customer-facing NBFCs right now? Generally, if you look at last few years, NBFC grew really well up to the time of 2018 when ILNFS issue broke out. Asset franchise is something what NBFCs relate to. They are the guys who do very well when it comes to assessing informal or self-employed customer segment, which is the largest population in the country. Then they are very well in collection efficiencies and meeting the customers fairly regularly. So maybe post-COVID, few things of these business model could change, but they always remain important and dominant category when it comes to lending business, as well as they would remain even in times after COVID. So netted, what I am trying to say or I am trying to conclude is on NBFCs, the better run, better parentage, and companies who have differentiation in terms of their product and delivery will come into, will continue to remain important, and their prices or their multiples would come back at least to the average multiples they used to trade earlier.
Sure. Chanchal, just taking a leaf out of what Dhaval was saying, and consumer, the sector that you track, in my sense, that is going to see the maximum change in the post-COVID world. I mean, we're going to think different, we're going to earn different, we're going to eat different, we're going to live different. How do you see consumption at large pan out in the post-COVID world?
There's so many different, I think the world will remain same. Some things will change for sure. The people want for hygiene will take a leap bound. Then the people want for convenience will take a leap bound. We will look to food as a category. If you see, all of us are working out of home and eating at home. So the ready to eat and ready to cook food will play a very important role. If you see the entire staple space, food is $100 billion industry, but the organized sector is hardly 20%. 80% is unorganized. To give you an example of a small thing like biscuit, people say biscuit is very organized. Biscuit is a 35,000 crore category. 1/3 is unorganized. If I were to take up all the local bakery stores around you, that itself is a 35,000 crore market. So the market itself is 50% unorganized. As people stay at home and as people look to eat at home, cook at home, they will look to have ready to eat and ready to cook food. And packaged food is the industry which will see a huge growth going forward. The other thing which I can think of is a quick service restaurant. In India, all of us want to have food at home. You know, Aisa, there are hardly any two brands in India with more than 500 restaurants. 10 years from now, we'll have at least 10 or 15 of them. So quick service restaurants will evolve in India. We'll not go out and eat anywhere. We'll look at hygienic places to eat out. The last part I would like to touch upon is the cosmetics. When people work out of home, the use of cosmetics will reduce.
Tell me about it.
Yeah,
No,
so I think
I'm an exception.
Some part will reduce for sure. So the cosmetics may reduce, but the other personal hygiene in terms of sanitizer, hand wash will take a bigger factor. And companies who are able to evolve in this space are the winners. So food as a category, I think, is a huge opportunity. These companies can grow at 10 to 15% CAGR for 10 to 15 years, and the personal hygiene space will evolve. So those are the things I think will change post-COVID.
Sure, makes sense. Dhaval, let's get back to pharmaceuticals, and let's talk about domestic demand here. Is the domestic demand robust for pharma, or during this COVID quarter there could be those volatile bouts because of overstocking of medicines? Just everyone's hoarding whatever they can lay their hands on right now.
So what happens is, if you look at monthly numbers, then there is a lot of noise that you would see with 1 month getting that overstocking phenomenon, but and the subsequent months were witnessing a decline. But broadly, if you were to look at a long-term trend for domestic market, there are key structural drivers to this long-term trend of what we are trying to look at. And so if you were to highlight a few of them, first one is favorable demographics. If you were to look at India as a country with 138 odd crore population, 20% of our population is either above 50 years or children below 5 years, which actually require more medical attention. And, how does that pan out over the next 10 years? By 2030, while the population will also increase, the overall percentage of population which will require higher medical attention, which is above 50 years and below 5 years, will go to as high as 30% of the population. So, in the span of 10 years, we will be adding 20 crore more people who will require more medical attention. That's like adding a population as big as a Pakistan or a Brazil to, people who require more medical attention. And that's where is a structural driver when you look at, that the overall demand for pharmaceuticals in India over the next 10 years looks fairly robust. Another trend, you look at per capita income, and globally we've seen that as per capita income, increases, the spend on pharmaceuticals typically increase. So, here we are at around 3.5% to overall GDP in terms of the overall spend, and global average is somewhere around 10%. And that is clearly a trend which can actually increase. Third and very important trend is again, government spending or expenditure on healthcare, as a percentage of GDP is only 1.5%. Even the emerging market numbers are closer to 3 to 5%. With COVID, I'm certain that, government will now want to expedite this. And earlier they were looking at increasing it to 2.5% by 2025. But that looks to be, fairly front loaded now in terms of what we're trying to look at. So there are a lot of structural factors which says that, to grow at around an 8 to 10% kind of a CAGR for the next 10 years for, domestic doesn't look fairly difficult from here on.
Okay. On that note, Chanchal, let's talk about, or actually Dhaval, let me ask you my second question, Dhaval Gala. We're going to be banking differently in the post-COVID world. Already there is that emphasis on that I don't want to take cash transactions, digital payments are the next new thing. Do you think private banks which have a large digital presence automatically will get that edge as opposed to others who are still very lean in their digital presence in the post-COVID world?
So this is a very important trend, and it's definitely very important for entire financial services industry. One important thing we need to understand is that a few banks way back in 2015 had made a significant inroads when it comes to digital offering, as well as a significant wallets, ways of payments or channels of payment to do other than branch and ATM, which was the historical things we used to do for payment or collection or removing money. Now, if one has to understand post-COVID, if I have to just rewind and go to data after demonetization, almost 55% of transactions for the calendar year 2018-19 used to happen through non-banks, basically bank branches and non-ATM channels. So that's a very large number. And even in that non-bank and non-ATM channel, there is a wide ways of debit cards, credit cards, UPI transfers, and wallets. Everybody has a decent share. So the payment industry is doing really well. Recently, there was an organization who had a credit card organization also got listed, and we understand the euphoria around that. So point I'm trying to make is that post-COVID, the digitization pace will accelerate further. Definitely, social distancing will remain for longer. And in that backdrop, I think digital will only not be important for payment industry or payment side of the banking business, but also the loan disbursements, underwriting on interviews like this when one has to take a loan, and maybe servicing through Zoom or some Microsoft Teams or other apps. So these things would come into play materially. Banks have very well started doing that. Not just banks. If you look at industries in mutual fund industry, insurance industry, most of them have started doing really well, even when it comes to doing KYC on digital modes. So this is definitely key theme. In my opinion, few companies, maybe public sector banks or few organizations are behind the curve to an extent, but I would say State Bank of India is doing really well on that. So if one has to look at few data points, when it compares to Western economies or Western countries, India has leapfrogged into digital when it comes to both payment as well as underwriting. Basically, both sides of the balance sheets really well. So I remain very optimistic. This side of the business doesn't get impacted whether it was COVID or after COVID. It only accelerates further.
Yeah, absolutely. Chanchal, digitization brings me to retail because I don't know when any of us would be headed to a mall or a physical store next. In this, norm of social distancing, you'd much rather prefer not to. More so for retailers, it's going to be imperative to have large digital presence. And if they don't have that, then they're going to be, clearly out of the race.
Sure, sure. So you touched upon a very interesting point. Digital is no longer a structural advantage companies will have. It's a necessity. You need to have it and you will have to have it. A couple of backs when I used to meet a company, I used to talk about what's the omni-channel strategy. Omni-channel is a new word. You have to have your omni-channel strategy. When I go out to a store, if I can't find something there, I should be able to order online. That was what company was building up. But today with the new COVID world, people are ramping up their online strategy. And going forward, we'll see retail, both in terms of e-commerce, will evolve. The other interesting thing is that local grocers, which were a dying thing few days back, local grocers have played a very important role in each and every one of our life. And I think someone who is able to digitally capture local grocers will be able to win over longer term. Now, if you see retail as a space, the 4 big categories are grocery, apparel, and then you have consumer durable and jewelry. Specifically in apparel and consumer durable, globally, online has become some 40-50% of sale. In fact, even in India, 70-80% of mobile is sold online. So I think apparel and consumer durable is the one which will see fast ramp up in the retail space.
Sure.
Grocery and others will slowly evolve, but I think omni-channel is there to stay and digital is there to stay.
Dhaval Shah, what about healthcare? Can that as a segment grow faster as opposed to pure play pharma, or there's bound to be aberration there as well? Because non-COVID treatments clearly have taken a back seat right now.
Right. So, if you look at the healthcare as a pie, it has a lot of subsegments, and pharma is just one of the subsegments that you're trying to look at. Non-pharma is about hospitals, diagnostics, wellness is something which is there. And even include API and specialty chemicals there in terms of contract manufacturing. So, when we look at that pie, each of these subsegments has their own nuances in terms of, where are they placed and how are you trying to look at from a growth perspective. Let's take hospitals. India, in terms of penetration, has 0.9 beds per 1,000 population. If you compare that with, overall global average, the global average is somewhere around 2.9. So just to give you a context, the whole of India for 140 crore population, we have total number of beds around 12.5 lakh hospital beds, which is what US has for almost 1/3 of the population that India has. And that is where there is a big opportunity in healthcare to actually improve penetration on a per bed basis that we're trying to look at. In fact, if you look at the largest private sector company today, has only 7,500 operational beds out of their overall pie of 12.5 lakh beds. So for many of these entities to keep on growing at around somewhere around 15% kind of a CAGR for the next 10 plus years doesn't look very difficult. And that is where it's a very big pie. And I think there is a bigger demand for private sector to come in and participate in that in terms of what you're trying to look at. Similarly, diagnostics, it's overall $5 to $6 billion kind of a overall diagnostics pie. But again, if I were to look at the whole setup, 45% of them are single mom and pop shops which are operating. India has this peculiarity that we have almost 1 lakh pathology labs which are there, versus our neighboring China, which has only 5,000, and in US almost 85% is catered by only 5. So here the top 5 players only command 15% of the overall pie, which will drastically change over the next 2 decades. And that is where for them to grow above 15% CAGR for almost a decade is again not far-fetched. So those are the two segments which are actually growing really well. What COVID has done is, this whole issue, API manufacturing as well as contract manufacturing that we were trying to look at for even specialty chemicals, which was more China oriented. All of a sudden the world has actually woken up that whether we want to diversify our sources, and that is where India has this big opportunity up there to grab. And if Indian companies get their act right, if government provides the adequate infrastructure to support them, in terms of building large parks, which a couple of state governments are actually talking about, then we can clearly see that in each of these segments we will be able to take up a large pie, away from our neighbor, and that will add to a very good growth rate that we're trying to look at for the next 5-7 years for each of these segments that we're trying to look at. So net, non-pharma healthcare looks, fairly exciting. They're faster growing than, overall pharmaceuticals that we're trying to look at. And we would expect they will form a larger proportion of the overall healthcare index as we move forward also.
Sure. Dhaval, if I could, come to you, Dhaval Gala, where does microfinance fit into the picture? And I say that because even right now the finance minister is talking, and in light of all the announcements made by her yesterday, the relief that was announced for the MSMEs. Now, the interesting thing is that some of these microfinance companies, which have huge exposure to MSME segment, most of these stocks or most of these banks are still trading at 2.7 times their price to book. Where would you put them in the investment scheme of things?
So first about microfinance sector, right? That sector is fairly important. It delivers credit at an efficient manner to the bottom of pyramid. The sector has grown at 25% on a YOY basis for last 6-7 years. And if you look at NBFC, MFI, because there are many banks like Bandhan Bank or few small finance banks doing microfinance as one of the key business. NBFC, MFI companies have actually grew 35% between the last 7 years. Firstly, microfinance sector has been very resilient. Way back in 2010, they faced Andhra Pradesh crisis. Then every 3-4 years, the last one being during demonetization, they have faced material issues. And what happens is that there are few companies who tend to not survive after that big sectoral or state related issues what they face. So they have largely been resilient and came back fairly stronger. Most of the sector has attracted a lot of capital as well, both on the debt and equity side. So what I would look at MFI companies right now would be, these are the most opportune time, because you would see in the next 2 to 3 months or 2 to 3 quarters, most of the problematic MFI companies unfolding and unable to withhold the problem. So you would find good companies within the segment who actually remains resilient and are able to provide for whatever NPLs they see in the next 2 quarters and come back stronger. So I don't know which companies you meant are trading at 2.5 or 3 times. I don't see
exactly the ones that you talked about, but anyway.
So they have valuations are already down for them, for most of them, and that's how they operate, right? They're most cyclical when it comes to, because every 3-4 years there has been one external shock, and they have come out stronger again and again. So during 2010, around AP crisis, the microfinance sector at large was less than 50,000 crores. Today, as we are discussing, microfinance sector at large is more than 260,000 crores of outstanding credit. So as I was talking about the growth rate, the sector has done really well when it comes to growing and reaching the bottom of pyramid, which remains one of the key agenda for RBI as well as Government of India. And maybe from an MSME package point of view, I think yesterday there was a 30,000 crores of package which was announced for NBFC companies below AA rated. In my opinion, a lot of MFI companies will be lined up to get money in, at least in that scheme.
Right. Chanchal, what happens to consumer durables? And I'm just taking a leaf out of rural micro lending here. How do you think will demand patterns pan out when it comes to rural India as well as urban India? Because channel checks seem to be indicating that while rural India is not as impacted by the virus, but the demand is not really seeing an uptick there.
Consumer durable as a category if I were to tell you, I'm very bullish on this space. For next 10, 15 years, there is huge opportunity, as power costs have come down and as the penetration increases. To give you an example, in India, will you believe it, the AC penetration is just 15%. Rural penetration would be less than 10%. So AC, refrigerator, there's a huge headroom for growth, and these categories will keep on growing for longer term. People will have AC in their house, people will buy refrigerator. Now, the interesting point which you highlighted was post-COVID what? Remember we were discussing about vacuum cleaner. So home automation as a space will grow post-COVID. So post-COVID, specifically in urban India, people will buy washing machine, people will buy dishwasher, people will buy vacuum cleaner. These categories which we were not thinking of buying, mostly all the urban will buy for some time. And these categories will also evolve in this space much faster than we think about. So consumer durable as a category, I think the penetration level are too low. We'll see the category grow for longer term. New categories will evolve post-COVID. Home automation, kitchen automation, these categories will evolve and grow much, much faster. So sometimes there may be some hit because of people may postpone their purchase because of uncertainty. But I'm very bullish on this space.
But then in the near term, you do agree that cost rationalization may set in?
I don't know. Will you postpone your vacuum cleaner? I mean, I'm just trying to. Will someone postpone their dishwasher? These are important categories. You'll have to go and buy it. In rural India, people may postpone their AC, but they'll go and buy it. The moment they get more money, these are the categories must have. Cost of electricity is going down, so you will have to have this. You will have to buy things for your, to make your home better.
Yeah, convenience, that's what it is. And if all of us are going to spend more times at home, might as well invest in these appliances. I'm all for it. But Dhaval Gala, jaan hai to jahan hai, varna insurance hai. Will COVID act as that big trigger that we've always been talking about, that insurance, once it gets deeper penetration, that's the sector? Well, there's no debating and denying that. But could this really be that mega trigger for insurance? Or have you seen any changes in trends in the last 6 months to a year where AP is facing some moderation?
So, two ways to look at AP, right? So, basically, for all the audience, AP is annual premium equivalent, or the total premiums which is collected in each year, new business premiums. So, maybe today, India, on a life insurance premium collected basis, the total gross premium collected for the life insurance sector is 5 trillion, basically 5 lakh crore rupees annually. And if you look at protection business, which is term plans, which is only 20,000 crores. In the last 2 to 3 years, a lot of insurance companies have focused on selling more of term plans because they are high margin business, and the under penetration is significant in our country. Today, almost 92% protection deficit is one of the means. If you have to look at, we are underinsured by 92% when it comes to pure protection or pure term plan. And if one has to understand the number of people who have protection policies in India, they would be close to 1.3, 1.4 crore people having a retail term plan. So and I did not tell you what is our statistics on outstanding, number of people, population, or even the people who are earning, or urban population, urban job population is also fairly 10x or 12x the number of what actual insurance or term plans have been sold. So what happens is, when you sell term plan, you have a lesser premium collection versus a savings product. So one may not look at total APE growth as a way to look at. Maybe what one has to look at the sum insured growth, as well as how the protection business is scaling up, and that would drive profitability for most of the insurance companies. And I think COVID type of pandemic, whether it in India or many other countries, makes you start feeling to have more of protection. So yes, this would be fade for a few months, because everybody will remain scared, and maybe the COVID continues for a little longer. You may tend to just buy more insurance rather than required or not required. At least people who are educated enough or who understand importance, they might buy extra insurance. There is other angle as well. There is general insurance sector. Even that would see a significant fillip in my view, because people are starting to hear about the hospital expenses. Maybe Dhaval Shah could talk more about it, but today also 70% of hospital bills in India are paid out of pocket rather than paid through insurance, medical insurance the people may have. So a point I'm trying to say is the retail insurance penetration is very low. A lot of us working in corporate India do have group health insurance programs. Even if one has to consider that, the overall, and even the government group health insurance scheme, which was started 2 years back, even now we only cover less than 50 crore people in country when it comes to health insurance. And the retail insurance, as I was talking, is only about 4 crores or 4.3 crores people. So if not term plan, but the retail medical insurance is definitely most important, and COVID would take that into account. The COVID experience may take that into account, and people would want to go for general insurance. So net, yes, this sector remains COVID free in terms of growth rates. What problems they would face is underwriting the insurance policies, because there is a lockdown and social distancing, and the policies, or for policies to get activated, you may need medical checkup or some pre-medical checkup. So there would be some issues when it comes to selling large insurance policies, but I think they would figure out that as well.
Yeah, that's a very pertinent point that you made. So great, we've got a great oversight on all the sectors that you track. But now let's talk about whether they're investment worthy or not. Let's talk about the valuations that each of the sectors that you all track are running at, and whether one can still go out and buy these names. And Dhaval Shah, let's start with pharmaceuticals. You know, do you really think valuations are still favorable, or with the recent run up and the re-rating that we've seen for selectively most pharmaceutical names, valuations are already at long-term averages? Or do you still find opportunity within pharma?
So with the recent run-up, the valuations have caught up with long-term average. So 1 year back, when we actually launched that fund, one of the 4 pillars was about trying to say that, the valuations are fairly attractive because of the fact that, they were almost 20% at a discount to a long-term average that we were trying to look at. And, now as we speak today, that valuation has already caught up to long-term average that we're trying to look at. But more importantly, while I gave you the 10-year picture and told you that, pharma was in a bear market over the last 3 years, and, this year we're actually coming out of that bear market. So we've just started actually coming out of that bear market, over the last 8-10 months that you're trying to look at. So while valuations are in line with long-term average today, the outlook, be it on the domestic side of the business or the export side of the business, has actually improved over the last 1 year. And that is where I would say that, we're fairly more confident on the overall earnings growth expectation from this sector over the next 2 to 5 years than what we were 1 year back. And so to that extent, from here on, if you were to invest in the sector, you would definitely get returns which is equivalent to the earnings growth that is expected out of the sector, if not for any valuation re-rating, because you can also argue for that depending on how the outlook pans out for the other sectors. But even if not for that, earnings growth definitely is fairly robust for this sector, and that should be the incremental driver for the sector today.
Sure. Chanchal Birla, that's pretty much the going concern for FMCG too, right? I mean, there is a Unilever which is trading at peak valuations at an all-time high right now. While there's no denying that the sector is a critical essential, while consumers may look for value for money, we can't live without these products. But the valuations are rich, so that's the sticky point. Can you still buy afresh within pure play FMCG names?
No doubt about it. The valuations are rich, and they have been there. This has been the argument for some time now. But if I were to talk about companies where earning can continuously grow, we've never seen the derating happening for companies where the earnings growth compounding is there, and there is visibility of earning. If you talk about FMCG in India, there is hardly $30 per capita spend. Compare this with a country like Indonesia, which is 2x, China is 4x, Vietnam is 5x. The amount of growth which can happen, and 40% of Indian population is less than 25 years of age. the headroom for growth of these companies are too high. Now, when you look to invest in companies, you look to invest in companies where there is earning growth visibility, there is a strong ROC, there is strong management, and the growth visibility is very high. Most of these companies have very high visibility of the growth. And the cash flow conversion to EBITDA, if you look at that parameter also of these companies, are very high. So some of these companies have corrected in this pandemic. But if you were to see in next 1-2 years, FMCG is where again you get high visibility because of the pricing power these companies have. They tend to pass through all these phase and they come out stronger in the after the phase. And remember, most of these companies, almost 50% of their operating profit is ad spend, which can be cut at this difficult time, or which can be rationalized. They can do a lot of digital spending and still maintain their share of voice. So I think if I have a strong earning visibility, and if some of this stock corrects a lot, we should add to this because the tailwind for longer term growth is very high here. And the ROC and the cash flow conversion defines which companies you have to buy.
So you're saying you would ignore the valuations that a Nestle, that an HUL are sitting and they're still a buy?
I'm not saying I'll ignore the valuation. I'm saying for sure some of these companies have corrected and they give a good opportunity to buy. So if I were to, I will not name any of the companies,
Sure.
but if I were to see the premiumization opportunity in these categories is huge. I mean, compare the amount of, so I spoke about $30 per capita spend compared to other average. I think the opportunity to premiumize and the opportunity to take consumers up the pyramid is huge. So the margin surprise can come. And if you see historically, companies have surprised us in the margin and the way they deliver profit. So if this company is correct, then you have to ramp it up and so will we do if you get a good opportunity to buy.
Right. Dhaval Gala, that can't be said now anymore for private banks, even the most sought after names within private banks, or for that matter, even within NBFCs. The route in the market is sparing nothing within financials right now. So valuations are not a concern, but where do you think have prices become that lucrative that you can step out and actually start at least nibbling into these names now across the financial sector?
So, definitely valuations is one important thing which everybody looks at. And you've already mentioned that the valuations are really lower or cheap when it comes to even for private banks. So just to take you to 2008 global financial crisis, what happened is there was similar route. Maybe the route continued for 12, 13 months, so you did not feel that. And right now it's been only in 2 months of COVID era that the prices have corrected really sharply. So I mentioned in the opening remarks also the franchise, how they are, the business model. So everybody's doing the normal same banking business, right? Taking deposits at low cost, trying to do it at low cost, making a good franchise of low cost deposit and trying to lend either to retail or corporate and trying to recover that money with interest. That's a simple business, actually speaking, to earn a spread. But not everybody is successfully able to do that in the past. You look at examples like HDFC Bank, what they went through 2008 to 12, or for that matter, other private banks, right? Most of them came back really sharp, well after global financial crisis. During then, we had a very good economic growth in the last 5 years, and therefore the NPL levels were very low for the system at large at around 2.5% to 3%. Today, when you look at overall system level NPAs are anyways closer to 9.5%. They would be going to around 11-12%, and I cannot make a judgment at this point how much more can they go and not go. But if you look at these top tier private banks, right, they would gain massive market share. Let's look at what is their franchise trend. So one, they have a low cost deposits, they have retail lending, they have digital capabilities, and today they are also able to cut cost or operating cost structures because they have become meaningful when it comes to market share versus what they used to have during 2003 to 2008 era. So the large private banks, in my opinion, will gain a lot of market share and a lot of profit share of the sector. Coming to valuations, most of these are trading at lower than the average valuations during global financial crisis 2008. Now we cannot paint the current era same as global financial 2008 crisis, or we don't know how long we should be going to history that the current era is comparable. And leverage being one of the key thing in the financial services business. So it's not easy to take a judgment for next 1 or 2 years earnings as well.
Right.
But I would say these large banks will get significant or disproportionate profit share till the time economy normalizes. And in that backdrop, the larger banks, the larger NBFCs, or for that matter, the top players within the each segment, whether it is insurance, life insurance, general insurance, mutual fund industry, NBFC companies, banks, most of these segments would have larger companies or profitable companies able to withstand the current challenges of COVID-19.
Sure, absolutely. Okay, on that note, gentlemen, it's time for our next session. So I'm going to begin thanking you all. It was lovely chatting with you and get an in-depth sense of where all these sectors of the economy are headed, not just post-COVID in the interim, but also for the long haul. Dhaval Gala, Dhaval Shah, Chanchal, all of you, thank you so much for taking the time out and speaking with us today.
Thank you.
Thank you.
Well, thank you for that insightful session, gentlemen and Aisha. All right, ladies and gentlemen, it's now time for the session that you have been eagerly waiting for. But before that, do remember to keep sending in your questions for our next speaker through the chat window or on social media by using the hashtag Voyage2020 and tagging us on @ABCABSLMF. He will be answering some of your questions as well. All right. Now, our next speaker spent 21 years as a risk taker, a quantitative trader, before becoming a researcher in philosophical, mathematical, and mostly practical problems with probability. He is the author of a multi-volume essay, The Incerto, and I'm sure you've heard some of the parts of that, the Black Swan, Fooled by Randomness, Anti-Fragile, and Skin in the Game, which are covering the broad facets of uncertainty, which has been published into 41 languages. By the way, The Black Swan has been named the most influential book of the last 75 years. Joining us today is Dr. Nasim Nicholas Talib, and he will be in conversation with ET Now's managing editor, Nikunj Dalmia, on the topic, Neither Black Swan nor White Swan, Don't Listen to Pseudo Experts. So with that, over to you, Nikunj. Nikunj, I think you're on mute. Right.
Well, thank you, Sumit. I think I must say, Sumit, you've been slightly unfair in introducing Mr. Talib. We've always introduced him as a financial author, as a risk taker. His most famous work, Black Swan, is something which everyone knows of because it predicted the fall of financial markets in 2008. But hold on, I'm going to read a passage from that book where he actually predicted an epidemic 13 years ago. And the passage goes like this. As we travel more on this planet, epidemics will become more acute. I quote him, we will have a germ population dominated by few numbers, and the successful killer will spread vastly more effectively. Nasim Talib, 2007. You saw this coming 13 years ago.
Yeah, I mean, what I is there's nothing particularly interesting in predicting pandemics because they've been happening throughout history, and we got even movies about pandemics and future pandemics. The central point is that our environment today makes these pandemics vastly more, dangerous because they spread much faster. And that is a problem. If we haven't, if we didn't have this connectivity that we have today, say we were in 1950, we wouldn't be talking now about this virus. It would have taken much longer to reach, maybe years to reach, some parts of the world. So we had to, so this is coming from a nonlinear effect from connectivity, a winner take all. Just like in the Black Swan, and I explain it as follows. When you have insulated islands, you have a lot more species per square meter. But as you expand to a continent, you see, you will have winner-take-all effects with some species dominating and small species disappearing. So we're seeing it in business-wise. Look at Google. 100 years ago, it would have been impossible for one company to dominate the planet in no time. I mean, it took 4 or 5 years for Google to really own the planet in its field. So this is, get used to this, and this applies to everything: cultural life, sports, fame, and of course, viruses.
When you say get used to this, are you making a case that you're not optimistic on a medical discovery and vaccine is not going to be discovered?
Okay, so what we're saying, get used to this, is we're going to have more viruses coming. Okay, that's one. I mean, maybe not tomorrow, or maybe tomorrow. Maybe we'll have antibiotic-resistant bacteria, which are vastly worse. We were lucky with this one. I'd say, honestly, this one spread very fast, unexpectedly for people who don't, understand connectivity. But it is still relatively milder than other viruses, say polio, smallpox, that can, really ravage a country. So now, am I optimistic on medical discovery? I am what I call realistic, okay? We've had AIDS now for about, 37 years, 35 years, okay? We still don't have a cure. We have a treatment. We don't have a vaccine. So herpes, for example, this may look more like herpes than respiratory disease. We still don't know. Herpes goes away and then comes back in the same person, you see? So it stays dormant. It's not common to respiratory diseases, but now we're realizing this may not be even the respiratory disease. So what I would say is, I'm very hopeful that we'll have a cure, a treatment, a pill you take if you have the first cough. Very hopeful, but I cannot rely on it. I'm not going to run my life based on hope. I run my life based on hard information, and we have been disappointed by by medicine. At the same time, we have had surprises, nice surprises. Antibiotics came as a nice surprise. Now some treatment for melanoma cancer came as a nice surprise, but you can't really bank on that. Now we have practically every single researcher in medicine on the planet is involved in some way or another in this, okay? Will something come out of it? We don't know.
So whom should one believe, Mr. Talib? The maximist who say that the only way to survive is that you stay at home, maintain social distancing, or the minimalistic? There are few in your country who say that, look, you got to come back to normal.
Okay, so let me tell you the problem with this reasoning is a lot of people have been promoting, maybe often because they're connected to the travel industry, or casinos, or something like that, losing money. They've been promoting the idea that it's either the economy, all right, or the virus, not realizing, as many countries have been discovering, New Zealand, for example, Taiwan, that effectively the best way to help your economy is through a victory over the virus. That's what's central. The other myth there is that these people are promoting is that they think that the economic drop comes from the measures, not from the virus. But now there's evidence in practically every country, even Sweden, where the government did the minimal, okay? Even Sweden, that restaurant bills experienced a plunge, okay? Economic life experienced a plunge, okay, except for cosmetic. And then as I show you pictures of some people in restaurants, most restaurants are empty, and these pictures contradict the hard data we have about consumer behavior. We know for example, that a lot of companies I'm associated with are not going to go back. Even if the government said, okay, everything is normal tomorrow, we're not going to go back to work if we can work from home. We're not going to expose ourselves to a virus if we can help it, okay? And practically everything elective has been canceled. If you see like conferences like this conference, okay, if there's the smallest risk, it will all take place next year or next time you're going to do it online. You see, if there's the smallest risk. So what's happening, it is not the measures against the virus, it's a natural human response. And the problem, the economic problems are vastly greater coming from the virus than they claim.
So I'll turn your attention now to the economy. Let's first start with financial markets. There are 4 factors, Mr. Taleb, which are at play. Medical crisis, economic crisis, oil crisis, and central bank crisis. These 4 factors have never come together. And yet markets are at, NASDAQ is in the green for the year and Dow's hardly down 17-18%. Are you a bit surprised that when we are using words like pandemic and crisis and panic and fear, markets are behaving as if they are Teflon coated?
Okay, so there are 2 issues here. The first one is some segments, more reflected in NASDAQ than other indices, some segments, such as technology, and then now we're using technology, Zoom, okay? So all these technologies visibly have rallied because they've been displacing, okay, travels to conferences. So it's more reflected in NASDAQ than in airline stocks that went down big time and probably will not easily recover. So now, you have to think that every time a crisis hits, you're going to have a lot of losers, but you also have winners. And the winners here are the industries that are capable of adapting. So the travel industry may have not adapted. They may not have ideas for the time being. And people are starting to drive their car instead of flying, okay? So, airline will not do well. Hotels will not do well. Airbnb or other similar things will not do well. But some people are doing very well. People selling you, for example, ways to disinfect the room, all right? You go to your office, you can disinfect it. These are doing well. People involved in selling masks, they're doing well. A lot of Amazon is doing phenomenal, right? People who deliver, I mean, so we have a shift in the economy from one sector to the other. That's the first point. The second point is, and that's something I learned sorely, all right, as a trader, that practically every crisis leads to an overreaction on the part of government that leads to stocks rallying abnormally because they inject so much liquidity they target the stock market and they inject liquidity. And that started in 1987. In 1987, we had a crash and stock markets was still positive on that period. Why? Because Alan Greenspan, the former Fed chairman, realized you had to print, okay? Or print or lower interest rates. Now the Federal Reserve has lost one weapon, interest rates, because at 0 you can't really go negative. There's arbitrages, but they have the monetary policy arm is not just lowering rates. They can print money to buy your commercial paper. Okay, the commercial paper of a Maltese bank in New York, they buy it. Anything they see that's on sale, they buy. So that definitely will prop up the stock market for a while. But remember, okay, nothing is permanent. Okay. When they stop buying, or if they realize that what they're doing may be inflationary, okay, then things go back to normal. So the one thing I've learned in the life of 37 years since I started trading, very counterintuitive, is that recessions are very good for stocks because the reaction to recessions makes stocks rally, and booms are very, 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 very bad. They make the stocks very volatile because, of course, they're going to raise rates and people have substitutions into bonds. So this is one of the reasons why stocks are not collapsing. But if outside the stock market, okay, which which is investor-led, by people who just put money but not work. If you walk around, you see nothing but businesses closed. So you have entire sector that will not come back. So number one, rotation from sectors like real estate will do very poorly in the office building, okay, and of course in retail because people are buying now on Amazon will do poorly. Other industries doing well, and over time the economy overall will adapt to that. Will adapt in the sense that I'm adapted. Look, I'm a professor. I have a studio now in my home where I have a blackboard to lecture on a blackboard. I'm adapted, and it's actually a lot cheaper for universities or for conferences to take place online. Okay, you don't have to fly people in. You don't have to clean the offices. You don't have to, provide food. Everything's much more convenient, and you're cutting down on commuting time for a lot of employees. So I am adapted in that sense, and I mean, I hope for the best, but if it doesn't happen, I am adapted. A lot of farmers also are adapting. So we have an adaptation period. It seems to me that within 2 or 3 months we'll be so adapted to this that some people will thrive and will even regret normalcy. But I don't think we will have normalcy for one reason, unless there's a miracle cure. And we know what happens with miracle cures. You have, they make the front page of, at a time there was a rule: if a cure makes the front page of Newsweek, it's not a cure, right? That was a rule in 30 years ago. So like interferon, cure for all viruses, no, okay. So if we have a cure, of course, people will wait for side effects, failures, maybe a vaccine that doesn't really adapt to new mutations of the virus. So even if we have the cure, people will still be paranoid, okay, and will not gather in bars unless, I mean, we're talking about young people maybe, but reasonable people will not gather in bars, will not go to crowded places, will not get into crowded elevators, will not go to crowded, if they have the chance. And it looks like they have the chance, you see. And even the restaurant business can adapt. Like I'm now in Atlanta as a refugee, but I have a place here and I'm enjoying it. And I've noticed that there are restaurants that are entirely outdoors. And these can thrive in this new environment with a proper distancing and ventilation, okay? But of course, you can't do that in the middle of the winter in New York. So there'll be losers, permanent losers, even if we have a semi-cure for the virus, or announcement for a cure. It will take a long time for people to really believe that it's risk-free to go to crowded places.
India has so far managed to contain the virus. On the medical front, the lockdown has been a success. But do you think in the medium term and the short term, this lockdown is going to cost Indian economy a lot?
I think that it's a false economy again. It's a false economy. Maybe the money you've saved from a short lockdown, you see, when you have a short lockdown, you save money for later, okay? Compared to, think about New York, think about the United States. Because although even we don't have a lockdown, there's a drop in economic activity and we're prolonging the effect of the disease. So I think that India had a very reasonable policy. India, Taiwan, Hong Kong, New Zealand, Australia, these many countries had very reasonable policy. They acted early, they acted wisely, they acted according to precautionary principles, and they had a morally acceptable stance. And let me talk about, if you don't mind, about my moral stance. Saying we're going to sacrifice the elderly because, you know what, we don't need them anymore, is something that would not cross any mind outside Sweden or some countries, some rich countries. Okay, so what we call geronticide, killing the elderly, by saying this disease doesn't affect the young, which is actually bad reasoning because we know that disease also affects many young. Okay, and we don't know, as I said, the long-term effect. But seeing these stances, okay, that they're morally not acceptable to many cultures, and including the Indian culture where you have respect for the elderly. You see, they're not accepted by Mediterranean culture because for the Romans, senatus means the older person. This is why they had the Senate. The Senate is the council of the elders, okay? So not only you wouldn't kill the elders, but they had a prominence. And the Arabic word shaykh What does it mean? It means older. So seniority in age was effectively social seniority, intellectual seniority, and political seniority. So what we're facing here is a divide that few are noticing between the two worlds. Okay, the world that has the ancient world imbued with ancient values, and a new world that succeeded economically over the past, say, 75 years. Okay, and now we're seeing that maybe their moral advancement is not there, and that's going to cost them. And even then, now Sweden, for our friends here who don't know the story, has decided to let the thing go. Okay, they say, okay, it will burn through the population, it will kill a few people, and then the young will not be affected, which is turning out to be a very bad idea because many young are affected. We don't know if something they call herd immunity works. We don't have no idea. And what is worse is that their economy is also suffering. You see, this is the poetic justice is not only they're killing the old people, but their economy is also suffering. So this is why, I mean, so sometimes people put you in front of a dilemma. Okay, this is a cost benefit analysis, and a lot of countries, including India, including countries in Southeast Asia, countries in the Middle East and the Mediterranean, would refuse that on moral grounds.
Before I get into India's specific question and we start talking about risk, as a statistician, I'm sure you've studied viruses and the history. This virus has seen a winter and a summer. It has survived. Monsoon is about to come. It has only started in Japan and parts of China. Do you think the virus could spread more, or it could be normal?
Okay, we don't know. The idea, you see, let's look at the reasoning on why we're talking about pseudo experts. That we've discovered, my friends and I, we study macro things, okay, macro properties. I just have a paper coming this week in either this week, next week in Nature Physics on what we call the fat tails of pandemics, which is effectively what drove me to write that comment that you nicely put in the Black Swan. I mean, the comment in Black Swan that you nicely mentioned. That was driven by some kind of, anecdotal empiricism I did that we formalize now with Nature Physics. You look at the macro property, the systemic effect, not you don't go from a micro to the macro, you go from macro properties to micro decisions. So it turns out that people involved in medicine were too myopic to understand that maybe it's not the thing you have. Whereas when you look at macro, you're much more skeptical about claims. So in the beginning, they thought it was like SARS. And on January 26th, when we issued our warning, we said, maybe it's like SARS. Okay, we're all okay. Maybe it's not, okay? So now there are a lot of things saying maybe it's not. So the claims were initially that don't worry about it. Wuhan, that was in January, has a harsh winter. Look at on TV, all their hats and stuff, therefore, countries that are warm don't have that. And effectively, the influenza, okay, and people thought, oh, just another flu, maybe a little worse, but within the same category. So they had a category error. So they thought that viruses, okay, this class of viruses, for some reason, okay, do not like summers, either because more people are outside or maybe because the nature of the virus doesn't survive on surfaces, whatever. And then they had a lot of theories. And then we said, you can't, okay, because we still don't know enough to make these assumptions. When you model, you have to look at the macro properties that are robust and common to all diseases. And the more you know, the more you can narrow it to the category and say, oh, less harmful than, but here we still don't know in the absence of information. Okay, and we still have no information. We still do not know anything about, people were not recommending masks till recently, when in fact masks could have saved the US economy, you see? So even the President Trump doesn't use masks, but they realize that from the beginning, okay, they thought that like some other viruses, it was transmitted by contact, not via aerosol or droplets in the air. And it's turning out not to be true. And masks are incredibly effective, okay, for things that are respiratory, because it's filter on both sides, okay, and compounding the filter works very well. After 2 or 3 person, you can pretty much lower the transmission. Anyway, so what I'm saying, so to summarize, it is, we cannot make assumptions of seasonality before seeing a lot of seasons, okay? So I would stay on a maximal alert. I would hope, that, summers would high temperatures, humidity will harm it. But in the meanwhile, I would wait.
Okay. Now, before I shift focus to risk and asset allocation, I'm going to just read off for everyone in the webinar one quote of Mr. Talib. People have the problem of denial. This is one of the biggest things I have learned in the Lebanon. Everyone who left Beirut when the war started, including my parents, said, oh, this will last 2 weeks. It lasted 17 years. I guess that is what he's trying to refer to this virus. Please don't be in a denial mode. Learn to live with reality that virus is here. Like he told us a couple of days ago, plague lasted for more than 200 years. So I'm going to just shift focus, Mr. Talib, and talk about what should one do. You're a risk taker, you are a trader. Yes. Let's understand by where are you investing and how are you investing personally?
Okay. Yes, in Skin in the Game, I said that I will never recommend anything that I don't have myself out of for moral reason. That way, if my recommendation is wrong, I lose money. It's good. I have good conscience. I hate gold. I've always hated gold. Unfortunately, I own gold. Okay. I hate European currency. Unfortunately, I own some European currencies. I like land. Okay, so I own land. I own olive trees. It's not economical for now, but I feel comfortable. Why? I feel it's a good repository of value. So now let me tell you what's driving my thing. I have 2 fears. Okay, one fear is of deflation and one fear of inflation. And I've learned through history that there's no such thing as inflation anymore. Okay, there's hyperinflation or nothing. Okay, so now we are in a deflationary environment. Okay, not for some things. Okay, but typically you can feel a deflation. It can switch very easily because it's throwing so much money at it into something great. So I want to hedge to make sure my funds, my savings, that they are unaffected by both deflation or hyperinflation. Okay, so I have a large portion in things that for paranoia. I am making bets. Odds are I will lose on them, but they're usually protective bets against long-term bond rates, because I think that eventually, if they keep at some point, even the government of the United States, you see, if the Chinese stop buying bonds, okay, the Arabs stop buying bonds, even the government of the United States may not be able to issue bonds to pay for this, okay? So you cannot just have the Federal Reserve buy your bonds, okay? It becomes sort of so circular. So, and I have, of course, what we call tail risk hedge. And I would like, in phase 2, to invest in some businesses that are both robust to recovery from this and robust to the virus. You see, some companies may not be robust to the recovery. Like, for example, delivery services. Okay, a lot of people may not be. These are booming. Where I live, you have food delivered, stuff delivered. So Amazon may suffer a little, okay, if you have normalcy, but there are some businesses where I think, like what we're doing now, Zoom or some other, they may gain, because we've discovered a new way of doing business, and a lot of employees would like to stay home independent of the virus, simply because they find it more effective to not commute. Some people commute for 3 hours to New York City. So there's some habits that would be permanent. So try to identify companies that are robust to both the recovery and boom during the virus. Then, and as you said, I would hope that this will last 2 more weeks, but I will act as if it's going to be 17 years. So there's a difference between what you hope and how you act.
If I increase the time frame, which is terminal. A lot of experts use that. Let's look at terminal investing. 1 year, 5 year, and 10 year. Would you still like to buy gold in every basket?
Okay, so let me tell you one thing that one dogma I have. You should invest for tomorrow and you invest for 100 years in exactly the same way. And let me make an anecdote. The main difference between an investor, what's the difference between an investor and a trader? Well, a trader who loses money on his trade becomes an investor. They say, oh, I'm in it for a long term. If they make money, they get out. So you cannot divorce, if you depend on what happens tomorrow. If you cannot say I invested for 100 years, if you ever had to change allocation tomorrow based on new information, then you're investing for one day. So this and this is a big thing. And actually, it was strangely enough in my first technical book published 23 years ago, Dynamic Hedging, where you explain that it's what I call the Markov property. You see, that there's no and effectively it's a wrong way to approach problems. I want to invest for tomorrow, okay, but I treat the same way. So and it's the same reasoning as saying, oh, plane crash. We have plane crashes on average every 20 years, but I'm only going to travel for 2 days. You can't really, it's a memoryless process. So this is how I treat it. So I would treat everything at both short-term and long-term, okay? And I would say everybody should do that, because if you invest in say I'm investing for 20 years, if there's any reason for you to change allocation tomorrow, because you found something monstrously more attractive, okay? You saw the great mansion, someone's bankrupt, selling it, and you switch out into this, then you're effectively investing for 24 hours. You see, this is what I call the memoryless investing. Okay.
Bala is on the other window and he's smiling. So Bala, was that in reaction to when he says that invest in gold or something else, Bala?
I like the word that he used. A trader, when he loses money, he becomes an investor. So that's what normally happens in markets such as today. So since you have asked me to react, and I also have questions to him, that we have a lot of audience who have been advising lots of the investors to put their $1 billion of hard-earned money into the market. What is your one advice to them that as to how one should they go about advising their customers, communicating at the regular interval for constructing a good portfolio that can deliver long-term return?
Very good. That's great. I'm shooting for long-term return, but I'm investing, with them in mind what can happen tomorrow. The most important thing is to be able to trade out of what you have. The most important thing is liquidity. So I think that the gods created financial markets for us to be able to change our mind. And this is invaluable. Like, for example, if I invest in something that I can't sell for 20 years or 50 years, okay, then I'm losing optionality, because if I find better investments, I'm telling you, if tomorrow you walk down the street and someone's selling something the equivalent in size to the Taj Mahal, right, for almost nothing, okay? So all your investment strategy goes out the window, because this is so attractive. You have to be able to switch. It's the same thing when we call that optionality. You have to invest in a way that allows you to get out. And this is why financial markets are extremely useful, because you can get out, okay, to find an alternative. You can switch to something, you see. It's still a very good investment, but I can switch out of it, you see. And that is central. Okay, having, like, for example, I own land and it's not liquid. And if I discover there's something vastly more interesting, I cannot get out quickly. So I have to have small allocation to that. The second thing I advise all investors, okay, is if you want to invest, say, 20% of your money in financial markets, invest 12% and keep 8% dry. So when you get a phone call for something attractive, you can increase, you see. And odds are there's a very small probability of you're not finding other. So what happens is that power dry is what people underestimate. Most people tend to over-allocate early. You see, it's much better to over-allocate late than early. So you see, so if I want to put 20%, you can convince me that there are things, okay, that can be attractive. Okay. I will not be able, and also be flexible. I may have to increase to 30%. If it's very, very attractive, there's no point not getting into something. You see, if I see a company that produces monstrously stable cash flow and has all the attributes I like, and you know, okay, I will invest more. So there is some. First of all, you have to pay for flexibility. That means sometimes underinvested. And the other is you may want to accept an overinvestment. So you should have a band of what is your average target, what you should be invested, you know, you should learn to invest under it and over it. So put a band. I want to be invested between 10 and 30%. My target is 20%. I may want to increase. Or you can be, say, 50%, whatever your allocation is. 50%, I may want to go to 60 or 40. And that is central. And also, every day wake up telling yourself, okay, forget what I've invested in. This is memoryless, okay? We traders should have no memory, okay? It's sunk cost. Forget what I've invested in. If I were to do it today, will I buy it today? You see? If I didn't have it, will I buy it today? Yeah, if I want to buy it today, yes. If I wouldn't buy it today, forget your past history, right? Because that is what blinds us to find something else. Oh, I wouldn't buy it today. Okay, then let me sell it and buy something I would buy today. So the cost of switch, the beauty of financial markets, particularly in their boom since like 95, 96, and this worldwide boom that we've had early in the bond market in the 80s, late 80s, and now in equity markets worldwide, it allows you to get out and switch. So there's no reason to sleep on something you don't like now. In the past, you're stuck investing in a company. You have to wait 5 years before you have a meeting, you know, with, you know, about, you know, to be able to get 10% of the money back or something. Now you can, now it's one phone call, not even a phone call. It's a keyboard entry.
Bala, any follow-ups?
No, I think I just had. I think you have advocated managing without buffer was irresponsible. That's the word that you have used. Does it also mean in times like today, one should also keep an eye on emergency fund while doing allocation to various asset class? I mean, you mentioned about land is illiquid, and does it also mean that one should also have an emergency fund?
Yeah. I mean, the idea is, again, never to be invested 100%. Okay, have emergency fund. This is what I call the barbell strategy. You have one part very risky, you know, but not all your portfolio, and one part, you know, minimum risk possible index for inflation. You see, and I put actually my land in a safe part because it produces olive oil. Okay, so I put it in that category. Now, by the way, I forgot to say I'm extremely honored, you know, by having this. And thank you for inviting me for the Aditya Birla mutual funds. This beautiful convention that's taking place online was great questions. So let me thank you.
So, Mr. Taleb, now let's understand.
Call me Nassim. This is one request. Nassim is easier.
You know, in India, we always say respect our elders. That's what I'm doing.
Okay. All right.
That's what I'm respecting.
Okay, that's good. Okay, that's fine then.
Really, on the lighter side, you must be the happiest man. No haircut.
Sorry? No haircut. Yeah, I have. Okay, this is another industry. No, okay. There are industries that I bet you will come back. Okay, even if we have a lockdown for 17 years, all right, the first thing I'm going to do when I exit from it is, because haircuts got to be done by someone. Haircuts, dentists and stuff, everything else you do virtual, but haircuts you cannot do virtual unless you come up with an idea and I would invest in that company.
Okay, Mr. Taleb, we know about your writings. We know about your thoughts on socialism and financial markets. As a trader, very little is known about what you've done in the past. If you have to talk about your favorite trade, and perhaps a trade which you think you love the most or you still have it, which will be that classic Nassim Taleb trait. Buffett takes a lot of pride in saying that, look, I bought consumer monopolies. I invented the word moats. What is that USP of yours?
Okay, no, I have spent my career not as a real investor or trader. I was doing complex derivatives and doing what I call tail risk hedging. But this is very professional and for specialists. Things that pay off big time if there's a catastrophe or if there's good news. These what I call optionality. So I would say that I would not recommend anybody from the general public to do it because it's very technical. Transaction costs can be hidden, okay, and prohibitive. But I would say, and I would say also, I'd rather be asked, what is your worst trade? And I'll tell you how my worst trade has made me probably richer than my best trade, and I'll explain why. But let me say in general, what I think is the trades that I've done right is having trades with bigger upside than downside. And that I explain in my book, Anti-Fragile. For example, instead of buying gold, and also I forgot to mention, I have gold, but I also have gold mines. Okay, why? Because a gold mine gives you the upside of gold without the downside. I have metals mine, other metals mine, things involved in copper and stuff like that, simply because that way you don't have to carry the inventory. It's in the ground and it's like a strike price. It's like an option. You have more upside than downside from gold mines. So they are volatile, but it's nice to have in a portfolio. So I think I've been the trades I'm comfortable, communicating to the general public that are very, very generalized and in agreement with my idea of complex option is the trades of having gold mines have more convexity. That's one of the class of trades. But you didn't ask me what the worst trade that I learned the most from. Yes. And I tell you, yeah. So okay, I don't know if you've seen what happened recently. Oil prices going negative. Okay, the oil prices going negative. Now, what happened? It had happened to me in the 80s to have a very similar situation. So in the 80s, we were dealing, and we ended up with having a contract, an option with a contract that forced us to get delivery of oil. And before you get delivery of oil, you have to inform the exchange, for delivery, where do you get your oil? Okay. And what happened then, there's a firm that acquired by Goldman Sachs called J. Aron, that was a bunch of shrewd commodity traders who squeezed rookies like me because they had rented, there was this oversupply of oil. That was the 80s. And what happened is that they rented every single storage on the East Coast. And oil, when you receive it, it's like a bad gift. You have to store it somewhere. It costs you money. And the EPA doesn't let you, dump it in the ocean. And they also rented every ship that can take oil to store oil on it. So then I learned, okay, not to be squeezed, I was squeezed, we lost a lot of money, and I learned to not be squeezed again, okay?
Great point.
And since then, sorry?
Well, great point. It's a great...
and it saved me so much money to not be squeezed. I was in my 20s, I had hair, okay, and almost like you, or no, actually more even, I was the same. I had hair, I was in my 20s, and it felt so bad to have that big loss, as they say, is your best loss. And when people, and I'm proud of my best loss. I've had similar losses, okay, where I get involved in something and I'm caught because there's a detail that makes it different from other contracts. And oil, effectively, you see, stock you can receive, it doesn't cost you to get it, but oil, you got to store it somewhere, and you can't just throw it away, and you got to pay people to take it away from you. We didn't lose, it didn't go negative at the time, but we had to pay people. We lost a lot of money from what we bought this oil, that paid people to take it away, and of course they knew, and they squeezed us. So that's one example of the best loss. So I would say another best loss was when and again, I talk as an old trader. So I remember the days when there was a cover story in Business Week, which at the time was a dominant financial magazine worldwide, and had a cover story on IBM.
Right.
Okay, as saying the big blue is the best company in the world. And this came in the nick of time, right before Apple came and almost destroyed IBM. Okay, and of course, so IBM is a great story, and all my friends say, "Oh, let's buy, you should buy IBM." And I was right out of business school, and I went in and bought IBM stock. All right, and I lost like so much money on it. Okay, that I realized that if it makes the front page of Business Week, or it means you don't want to buy it. It's too late. That's when you sell it.
Right. Okay. So, Mr. Taleb, every crisis gives an opportunity. That's what you've always said.
Yes.
When the TMT bubble got busted in 2000, money moved to emerging markets. When emerging markets, they started coming down, money moved to large US tech. Because of this crisis, what do you think would be the new normal of the world? Will US and China fight? Will globalization be under pressure? What are your thoughts there?
Okay. I don't think foreign policy is the place to look for huge rationality, okay, with geopolitics. I don't think so. But I doubt that it will have tension between US and China, only because the two countries depend on one another. And there's too much commerce, too much at stake on both sides, and you need people to buy your bonds. You need and then the Chinese need people to buy their products. So what I would think will happen is maybe a little bit of tension, because there are some initially now there's some things people say, oh, they should not be made in China, pharmaceuticals. So we're going to have some essential pharmaceuticals made here, maybe inefficiently, but as insurance. But we don't really care if this is made in China. My coffee cup, there's no particular national security involved in there. Or if my Apple computer is made in China, this is no big national security, And actually, they make them in China because the Chinese are better at making. That Apple said they're better. It's for quality, not for price. Okay, so I don't think there'd be tension between US and China, but I always keep in mind that governments can be very irrational when it comes to geopolitics. Okay, and effectively we can see it now with, my criticism of the US government is say, okay, you guys spend $1 trillion plus more in hidden cost, okay, building nuclear stuff. And you can't supply the population with masks. Okay, what world are we living in? So people are getting to be a little skeptical of geopolitics, and that's good news. So when you say what is the new normal, I think okay, we still have a lobby that wants to sell planes, to third world. To Saudi Arabia or whoever can afford it. So that's going to be go away. All right. The second point, oil prices. Again, the whole idea of having a gray beard and soon white, perfectly white, is you remember war stories, okay? And I remember oil. Oil is vastly more vulnerable than people think. They try to maintain a production, so the world consumes 100 billion barrels, and they produce, say, 98 billion, right? So they make sure they supply the world a little less. They got us addicted to oil. And now it's turning out that a little drop in airplanes and stuff like that, now they're on the other side. They need to produce more oil, all right? And we need to buy less. And we start to have small alternative things, like, for example, electric cars. Now, you may say it's small, but say, no, it's not small, it's marginally huge.
Right.
Because if the demand goes from 100 to 90, okay, a million barrels a day, okay, that's huge for the price. And we saw that in the 80s. And I don't know if you remember, or if you've heard, or if you've read, in the 80s, oil collapsed. So I think that oil is vulnerable on the downside.
Right.
Now, unless, now let me ask you, do you own oil fields personally?
No, I wish I did.
I don't.
Okay,
no, you have it.
Bala owned ones. I don't know about Bala. He's got a lot of things which he never shares with me.
Okay, so So unless you own oil fields, all right, the drop of price of oil is very, very good for you. Okay.
Yes.
That is what's central. So it's practically good for everybody except for Saudi Arabia, or maybe it's even good for Saudi Arabia. Okay. We'll see. It'll force them, to really get into other businesses. It's good for peace, Saudi Arabia, Iran.
Right.
It's very good for promotion. Said promotion of things that are, a religious fundamental. It's very good. The drop of oil is good for everybody except those who own oil fields. Okay, the very, very small minority, and it's there to stay. And the thing is, when you think about it, this is there to stay, because the big consumers, or the places where we spend a lot of money on, are definitely going to be have in mind. Okay, people will cut down on travel. Okay, even if we had a short-term cure like that, people will cut down. They're afraid. They build new habits. Right. They change in consumer habits.
Okay, Mr. Talib, I'm just going to interrupt you here because I'm going to turn attention to lots of questions, and trust me, there are hundreds of questions. We've got some we shift there. Before I go to it, I want to make a comment on a point which Mr. Talib just mentioned, that learning from mistakes. And I'm speaking from experience. The man on the screen, apart from Mr. Talib, my dear friend Bala, this AMC Birla AMC I've interacted with for years. Trust me when I say that they are learning from their mistakes. And every time I interact on Voyage with Bala and his team, I'm amazed with the processes they have in place. So Bala, my compliments to your team. Every time, like Mr. Talib says, that you manage to migrate, you become stronger, and you only become bigger as a money manager, as an AMC. But Mr. Talib, a question coming from somebody who's part of the webinar: why is the dollar strengthening when US is virtually bankrupt?
Because Europe is strengthening against what? Okay, it's not strengthening overall against gold. Gold is firm, although it was having deflation now, short term, and it is not. I mean, it's strengthening against Europe. Is that what do you say? Strengthening against what? Again, depends on. It's strengthening against Europe. Okay, that is from what I see against UK, the euro 108. Okay, that's not. I wouldn't look too much into the dollar for now, and remember that the US is not presently bankrupt. They're still printing the reserve currency, and they haven't printed so far. The printing is a project, okay, which is static. The money has not been printed, okay. I mean, largely has been committed, okay, but it's so we're in the third. We're entering the third month of printing. It takes a long time. Japan did that for how long? They've been doing it for 25 years, 30 years.
Okay. Another question is from Nitin Sawant, and he wants to know, Mr. Talib, you predicted the pandemic in 2007, the collapse of financial markets 10, 12 years ago. What is the next big calamity or casualty you want to predict?
I think I would be more positive about calamities going forward for two reasons. This pandemic taught us to deal with pandemics. Okay, we will know to react early and save ourselves money, because all these trillions spent by Western countries are caused by delayed reaction. Because think of Taiwan, they didn't spend trillions, right? They didn't have, the equivalent to their GDP. So I think that the world is safer today than it was a year ago. Okay, both economically and there. But we still have this government debt that needs to be cleared. And government debt is a problem that will definitely crop up, because when you enter debt, people ask you, why do you want the money? And then they start supervising your other expenditures. So maybe the financial market will give the US government money for stimulus and stuff like that, but they tell them, listen, these $1 trillion we spend on weapons, I don't see, plus more. I mean, we spend so much on Gulf War indirectly, plus the liabilities you get from it. Liabilities in terms of, pension funds and stuff. So that's what where we can cut. Okay, and also there's another thing: is academia is not doing very well in America. Okay, getting expensive, doing nothing, and for any subject, say epidemiology, all right, you can find better experts outside academia than inside academia. Like Stephen Wolfram, for example, and his son did an afternoon what took 15 years to do by a bunch of epidemiologists in the UK, team, the one that was advising the government. They did it, and then when we see their code, it's like, so what happens, academia is becoming the refuge of of the parasite, okay? And it's nice we're going to have a shake-up in academia that will, so we can expect going forward a shake-up in academia, a shake-up of bad management in the US for, because now guess who's coming asking for money? States. State of Illinois, the most inefficient operation in the history of mankind is the state of Illinois. And they ask us for money, us. So we're going to put that under scrutiny. And I think after some little bit of cleanup, the world will be better. So my idea in the Black Swan is I was identifying sources of fragility. It was a simple point, is that once you identify fragility, you've removed it. You see, half the problem is figuring out where it is, right?
Fair point. Mr. Taleb, investing in India could be different, a question from someone, because interest rates are different in India. US has 0, India has 6. What do you think it means for a long-term investor? And part B of the question, based on your understanding of India, Indians, the demographics and the government, which are the bright sectors in India which could deal and survive the storm?
Okay, so I will say what I last time I met you in India in December, and okay, of course I've been 10 times to India, but still ashamed of not learning Hindi because everybody talks to me in English. I mean, I want to speak some Hindi. So my project has been, thwarted by you talking to me in English, not forcing me to Hindi. Anyway, so I love India. And last time I was asked, okay, what is, so the world, you remember there was a book that was a little flawed that I critiqued called The World is Flat. Yes. And I said it's both right and bad book because he doesn't see the dangers of the flat world, okay? Because we're seeing the world being flattened. Sorry?
That's Friedman for you.
Yeah, Thomas Friedman. I don't like him, and then he liked the Iraq War and stuff like that. Anyway, but I said effectively he's right on the world is flat and wrong on everything else. Okay, that's what's good from it, because globalization, okay, increases connectivity, bring both this virus and the economic difficulties we have dealing with the virus because of fragility of supply chains. So, but I said there are places. Okay, now what's happening is that the rise of the West. Okay, English. Industrial Revolution, and then France, Germany, and so that rise may be just a blip in history because it doesn't look like the differential is, for example, if I want the best statisticians on the planet, I may find them at Tata Institute or Indian Statistical Institute. And of course, Zoom eliminates visa problems. So there's a lot of goods you can export now to the West in which you can have superiority. That's what my point is. The second one is that I don't know the structure of India, but I know that there's, I mean, from my experience, is that you have a lot of talent, okay? You see, and you don't need a lot of talent to be able to export ideas, and this will be easier. And now soon we're going to have, I had to, I was offered a visit to a doctor for the checkup. They wanted to do it on Zoom. I mean, so if you can do a checkup on Zoom, why not do it in India? Right? So that flatter world effectively favors countries that can still produce goods without, too much administrative expense, that swelling medical bills and swelling university bills. So maybe there'd be a university degree in India or some modules sold out of India by professors in India, okay, that will be, can compete with anything here. So that's one thing about India. But so when I was in India last time, people ask me, what should we be doing? I say, I'm not an expert on India. As a matter of fact, I'm not even e-commerce. I'm a risk person. But I will tell you one thing, okay? And as an entrepreneur, risk person, I'll tell you one thing that I've learned. The main asset of any country is risk-taking. Is young people, when they graduate from high school degree and then they want to go to university, not to think that getting a salary is a good thing, okay? You want to fail when you're young, fail when you don't have a family, fail when you still, okay? And so they said, how can you say, look at California, it is acceptable to fail. So, and the highest bankruptcy in the world, but before now, of course, it's the restaurant business. But before now was where in California, where in the most active sector, the tech sector. So they had California, Northern California, the highest rate of bankruptcy in the world of any region, and within that in the tech sector. So we have high bankruptcy rate in the most thriving industry, what it tells you that people are trying, failing, and then trying again. So, and then they say you got to try 7 times. Well, maybe not 7 times, but still instill in young people that the idea of being an entrepreneur and failing is like a soldier who is wounded in battle. There's nothing wrong with it, okay? And as a matter of fact, it's a badge of honor. And you have a very active tech sector, okay, and dangerously active for other countries. And you have phenomenal education at some level that you can export both. And they feed on one another. So this is what I think. So, but I don't know the details. I know that you have a huge market. Okay, so anything when you have a huge market, you can make all the mistakes you want. It still may work. Okay, and now you're telling me about the 6% interest rates in India, okay, versus other countries. And I will say that if you normalize, okay, given that India is not a reserve currency. If you normalize, if India printed money, okay, it would inflate. America is one of the few countries that can print money and not have a big effect because of their status as a reserve currency and other structural reasons.
Fair point. So Bala, before we wrap, any follow-up questions? You may have to unmute yourself.
I'm fine. Only one, I think you mentioned about various asset classes such as gold, copper, and oil, but you're not touched upon credit-related instrument, which is basically the junk bond market in US is one of the biggest, and you don't mention anything about bond investing. Is it something that you don't like it, or is not? You don't see it rewarding?
No, okay. If I owned S&P, all right, I would switch to buying paper instead of the S&P, okay? Simply because the government can prop up junk bonds by buying them, and actually they've been doing it, okay? And so that's why the junk bonds should have collapsed a lot more than it did, but still relatively more attractive than stocks. So no, I effectively, I do own junk bonds, okay? I forgot to say that, okay? I do own junk bonds. But you want to avoid owning anything that is related to commercial real estate. So you want to know where your junk bond is coming from, and what, of course, you want to avoid which junk bond. There's the funds, okay, that have the spectrum, and that's a bad idea because you want to avoid airlines. The real losers are airlines. In terms of fragility, if things get better, airlines won't get better, much better. If things get bad, airlines, or stay bad, airlines will get better. Okay, so airlines are not good junk bonds. Restaurants, chains, maybe, right, but not too much. But there are some junk bonds that are legit and do well. So this is why I would, plus the yield on junk bonds is attractive today. The government bonds went down, the government bonds went down about 100 basis points on balance. Some junk bonds went down 200-300 basis points. They should have gone down 1,000 maybe, but went down 200. I mean, it went up in yield 200-300 basis points. So you have some attractiveness, plus it's backed by the Federal Reserve.
Well, Mr. Taleb, we've almost done an hour. We've got thousands of people watching live this webinar platform. Millions will be watching it on Facebook and other forums.
Oh, thank you.
Delight on behalf of my channel Itina, which I represent from the Times Group, on behalf of Bala Birla AMC, one of the finest groups of India. Thank you for your valuable time. And by the way, Mr. Talib Bala is already working from his office because I recognize his office. So he's leading the company from the front. At a time, he's managed to go back to office. So well done, Bala. And
thank you.
Thank you.
Okay, great. Thank you. And nice. And hopefully next time in India, we'll meet. I've been 10 times to India, so I'll go 10 times more in the next 5 years. So we'll meet and I'll speak Hindi then.
On that note, well, when we meet somebody, we say namaste. When we say goodbye, we again say namaste. So with a folded hands.
Namaste.
Thank you very much for joining.
Thank you very much. Thank you. Thanks.
Well, thank you so much for that eye-opening session, Dr. Talib, and thank you, Nikunj and Bala. Well, ladies and gentlemen, I hope that you have been making notes. I know I have. What a fantastic session. All right, moving on to our last session for today. Now, some people call stock picking an art. They have a gut feeling about stocks and how they will move. Others say that it is a science based on detailed research and analysis. So who's correct? Well, let's hear it from the horse's mouth. In this case, some of the senior portfolio managers at Aditya Birla Sun Life AMC, who will be talking to ET Now's Abha Bakaya about the art and science of stock picking. I'd like to introduce your panelists, Ajay Garg, Anil Shah, Vishal Gajwani, and Satyabrata Mohanty. Over to you, Abha.
Thanks so much for that, Sumit. I think now more than ever, investors want to really understand best how to go about and build a portfolio that's also a secure portfolio with an eye to the future. So let's dive right in. Satyabrata, let me start off with you. In terms of how you'd perhaps advise investors to go about picking the right stocks at a time like this, when things are so uncertain, it's very difficult to really predict, which are going to be the companies that will lead us into the future. What would you advise?
See, during these times, or during most of the times, typically the type of stocks that I would recommend internally to our team, and also while selecting stocks for the funds that I manage, would be typically look at companies and sectors which have long-term potential going forward. The opportunity size should be large, and the companies preferably they should be leaders in their sectors, and there should be a track record of delivery in the past, so that we're not just betting on just a story, but actual real operations. They should have executed it on the grounds in the past few years. And of course, at this point of times, you would look at companies which have an extremely strong balance sheet, because at this point, when nothing is selling, none of the companies or sectors are able to sell at this point of time. So it's going to be a stressful scenario for the next 3 to 6 months, or maybe 1 year. So it is essential that the balance sheet is strong enough that you can withstand this stressful period, or period when your cash flows are quite stressed. So a strong balance sheet is essential at this point of time.
Okay. Anil, let me have you dive in as well and share with us a strategy that you're going by. If there are any particular kinds of funds perhaps that investors should look at if they do have the capital to get into markets at these levels.
So, right now it could be a good idea to, first of all, have a clear, 2 to 5 years perspective when you invest in. So don't look at, daily NAVs and daily stock prices. It's going to be a pretty choppy period ahead. I would generally request or suggest to them to look into buy either large cap or multi-cap categories and funds, primarily because these are better researched stocks, and with better corporate governances, better boards, better bandwidths, better balance sheets to take on shocks, And right now we are in a period of a shock, and the globe is in a period of shock. So I think clearly, for them, two things are important. Please look from a 2 to 5 year perspective. And second, for now, try and avoid the smaller companies, be in large caps or multi caps.
Okay, sound advice coming in there. Ajay, what about you thematically as well? Is it wise currently to go about a sectoral view? Would you stick to a very stock specific approach?
So basically, I generally tend to avoid a sectoral approach. I tend to be more company specific because once we start talking about the sector, then there itself we are surrendering to a commoditized world. So within a sector, we see like not many companies are somewhat similar. So it is all about the uniqueness of a company that counts the most. Amazon, Apple, Google, Microsoft, these are quite a few examples where they can be called as technology companies, but it is all about the very unique feature of these companies that make them tall and are $1 trillion companies.
Okay. Vishal, with so many mutual funds being offered right now, what about PMS? How does that add value to an investor's portfolio?
Yeah, sure. So I think the way we look at it is that PMS complements mutual fund schemes. For any investor, mutual funds will be the core part of the portfolio. However, PMSs do offer strategy diversification. So from that perspective, it does appeal to a niche segment of investors who are HNI investors who are looking to diversify beyond mutual funds. And in that case, for example, in our PMS, we have got certain strategies like innovation portfolio, or for that matter, India Special Opportunities portfolio, which looks at investing in turnaround stories. So such kind of investment avenues is something that is differentiate. The difference it's different from mutual funds, and it adds value to investors. So that's how we look at it.
Okay, fair enough. Anil, let's get a bit more deeper from, in terms of the kind of themes that are likely to play out. We've understood the kinds of companies perhaps that one should look at, but there's been a lot of focus on, let's say, financials on one end, pharma on the other end. Would you stick to perhaps those handful of financial names that seem to be driving the way forward, as opposed to, let's say, the slightly more defensive names where perhaps growth may still be a little bit more muted?
So, there's no, it'll have to be a combination as far as approach of the fund manager is concerned. Sure. You need to first really clear that you need companies which will withstand the next, 12 months, which is going to be a turbulent period from a business perspective. The stock price could, do what it does. So, you need to be sure that these companies will basically see through this period without any major deterioration in the balance sheets, number one. Two, as and when normalcy starts coming in, these sectors and these companies should be the ones which should take the lead in terms of gaining market share, in terms of a better, top line growth, better margins, and hence better profitability. So, this is what you really need to focus on. And this is what, one is right now doing so. Your questions on, banking, the size of the balance sheet really matters the most in a bank. So a smaller bank, obviously, in these kind of times is far much more prone to difficulties and far much more prone to issues, which could not necessarily be handled easily. Banks is all about raising capital at the right time. And, from that perspective, it would be a sensible approach to be into larger, well-capitalized banks.
Oh, all right. In terms of, if we take a look also at valuations currently, and Ajay, let me come to you on this. It starts to look very attractive when you see some of these companies trading at these kind of valuations. However, on the other end of the spectrum, some are still actually looking expensive given the kind of crisis that we're going through. How would you assess valuations at this point?
So, what has been my biggest learning is valuations though they matter, the entry price matters. But what matters much more is the getting hold on the earnings growth and the market share incrementally the companies are going to command. So most of the times in the market, when we talk about the valuations, we try painting everything with the same brush, and we kind of use a P or EV by EBITDA. So, these are just one of the very few matrices when you evaluate a company. So it is all about market share gains. What are the moats around the company as the company grows from being a small to mid-size to a large size company? So are they building moats around the same? So otherwise, what may happen is like as they grow, like in technology companies, we have seen a company may grow for some time, but then you'll have suddenly competition coming in. So those Kodak moments we need to avoid. So once you have the moats surrounding the company as the company grows and is able to manage the change much better and is quite grounded and doing a lot of ground research, they are ahead of time, spending significant amount of money as a percentage of sales in the research. So generally, these are the companies that command a high valuation, and rightly so, they should command a high valuation, though it may look high in the short term, but 2-3 years down the line, you realize, oh, it was available quite cheap.
Right. Okay, Satya, we've got a question for you coming in. What's your call on NBFCs as your portfolio seems very well balanced? That's coming in from Sholay. He's asking that specifically to you.
See, as far as NBFC goes, one of the sectors where people think that there is going to be a huge impact because of this current crisis is in the banking and the financial space, especially in the NBFC space. And there are expectations that job losses will happen, and so there could be a large amount of NPAs in that sector. So I think what will happen in the NBFC sector is that in this kind of crisis, what happens is the better ones, the top 2 or 3 players in that particular space actually stand to benefit when the crisis gets over. So I think it's better to shift your holdings as what we have done is that we have shifted out from quite a few of our NBFCs and consolidated our NBFC exposure into the top 1 or 2 companies. So I think it's going to be a stressful environment going forward for NBFCs. So we have reduced our exposure and concentrated on the top 2 ones.
Okay, I'm going to get to more sectors and stocks in a moment, but just a question for Vishal as well. On PMS portfolios, Vishal, there seems to be a perception that they have to be mid-cap, small-cap centric, and therefore take excessive risk to generate alpha. Is that correct? Because I can see that you've also flagged a few large-cap funds that are actually doing quite well.
Yeah, sure. So, Abha, we believe that, fundamentally believe that there is no relationship between high risk and high return. There are opportunities in the marketplace to generate decent long-term returns without taking too much risk. And that's been our philosophy in our portfolios, all our portfolios, to focus on risk-adjusted returns. And also coming to this art and science of investing, we believe that investing is a combination of both science and art, and we believe it's a science of exclusion and art of inclusion. So, for example, for selecting the right, for eliminating the bad stocks, one has to have scientific parameters, be it in the form of leverage, low debt to equity, high return on equity, etc. And then from an art perspective, one has to use judgment, one has to understand the business model and the quality of the management, and then finally decide which stock to select. So we believe it's a combination of both, and that's what we practice here. And our flagship fund core equity portfolio is having 75% exposure to large caps, and has been doing quite well over the last some time.
So actually talking about that was the best performing scheme from 2013 to 16, 40% CAGR versus 15% for the benchmark during that period. Then it underperformed for some time and then has again recovered. So what are the learnings there, Vishal?
Yeah, sure. So I think clearly it was a very humbling experience. We had a few one-off events end of 2016. One was demonetization, which honestly was a black swan event. And post that, a couple of stock-related events happened. One pharmaceutical company got an import alert. So the learning was that one has to actually be prepared for black swan events while one is creating a portfolio. One cannot rule out the possibility of black swan events. And therefore, while creating a portfolio, one has to look at, apart from quality and growth, one also has to look at the resilience of business to withstand such kind of pressures. And secondly, also diversify the portfolio into some of the sectors which are laggards and have gone through temporary correction and are coming back on track. So,
right.
Pharmaceuticals, for that matter, was having a painful period over the last 2-3 years, but it has now started to pick up. Similarly, telecom, for that matter, has been a laggard for 8 years, but over the last 1.5 years has done well. So I think we have diversified into such sectors like pharmaceuticals, telecom, and some of other sectors like insurance, which is what has helped us to come back on track in terms of performance over the last 1.5 years.
All right, you touched upon pharma, so let's talk about that then. Ajay, it seems to be a sector where everyone's starting to look confident that it's going to bring about fresh set of leaders, given the potential that we're seeing there under the current crisis. What's your take when it comes to some of the pharma names and the kind of return possibility they offer?
So when we talk about pharma sector, we need to differentiate the companies that are serving to the Indian consumers and the companies that are generic in nature and serving on a global platform, manufacturing in India and selling overseas. So in India, if you see, last 5 years, the pharmaceutical industry has grown around 10%, and it has been the most consistent and the highest growing industry. Next 2, 3, 4, 5 years, it is actually expected to grow minimum the same percentage, because as we go north of $2,000 per capita income, the healthcare spend is only going to inch up. People focus more on health. So COVID is it is going to accelerate the trend. So the trend is good, more so for domestically focused companies.
Okay, fair enough. Anil, especially after the recent set of announcements, we've now had a couple of press conferences from the finance minister, more to come. Does that give you any sense of conviction that there might be a few pockets that will see some amount of economic activity start to bounce back?
Yeah, surely. When you move from zero to anything, it definitely helps. It's been a long wait for the stimulus to come through. We started seeing signs of that. Yesterday was a large announcement from the government in terms of trying to help the MSME sector. To me, it's a great start. It will definitely make sure that these companies which were standard possibly have a great chance to survive this very difficult period. As I mentioned in my earlier reply, these are companies with very thin balance sheets and really need a lot of helping hand in these kind of events, which are completely out of anyone's control. And I think this will go a long way, if you ask me, in trying to help the economy move forward. Remember, MSME as a sector is one of the largest employers as far as this country is concerned. And if you can get your employment going, I think that itself takes care of domestic demand. That itself takes care of domestic economy, if you ask. So yes, I think it's a great start. And as you rightly said, more to come.
Okay, Ajay, in terms of identifying some of these stocks, I know when we're talking about picking the larger names, the ones with the strong balance sheet, we're anyway narrowing it down a fair amount. But given the current environment, have you, looked into a certain amount of reshuffling Have you taken a closer look at perhaps some of the earlier favorites that may not have the potential to perform as well in the current downturn?
So about this exercise keeps happening within our team on a daily basis. We with myself with a group of analysts and the other team members, we keep tracking the change, and change is what matters, especially so post demon that was way back in 2016, and after that we saw GST. Now we are seeing COVID. So these were the trends which were already happening, and we were moving from a physical economy to a digitized economy. So a portfolio doesn't change overnight. So when you discover things are not going to work out, and you discover there can be Kodak moments. So these stocks they find their way out of the portfolio. But we try to get into the companies quite early, and not many companies in our portfolio would have been there for like 8, 9, 10 years. And it is all about the company management and the leadership and the promoter category which it belongs to. They are ahead of times. They keep cash. So I'm not a believer of keeping cash in the portfolio. My companies, they have cash in their portfolio. So whenever there's an opportunity, they can just acquire and grow inorganically as well.
Okay. Satya, I have a question for you again from a viewer. Sunil Kamdar is asking if you could share your journey of the ABSL Balance 95 scheme.
Well, Frankie, ABSL Balance 95 scheme, I took over around 15 days back. So it has been quite a short journey. So I think it's only 15 days. So I'm just getting a feel of the fund. So, but the thing is that, see, I like to talk about what you previously asked, and maybe that is it's also will be applicable to how I'm going to manage BSL 95 going forward. See, what I think is that there were certain trends that were playing out in the economy and in other spaces, and we were thinking it will take 5 to 10 years for these things to penetrate deeply into the markets and to the economy as such, something like e-commerce, online, digital space, etc. But what has happened because of this crisis, that something that we were expecting to happen over the next 5 to 10 years has suddenly started happening within a month or so. So these trends have accelerated. So I think going forward, you might see, you'll see in the portfolios, you'll have. I would like to have much more exposure to companies which are involved in e-commerce, that digital something, and because of global supply chains getting disrupted because of the virus happening at different places at different points of time. So we think there will be a now people will diversify their supply chains, and there will be certain sectors which will in which India will benefit, especially I think in the chemical space, in the specialty chemicals and agrochemicals. That is one space I think where India will benefit because of global diversification of supply chains, and I think that is where we will have increased exposure going forward. So and also I think staples is where is a perennial performer, and I think that these staples are strong brands, etc., and they're going to play out. So I think those are the kind of things that will play out in the future, and maybe in BSL 95, so yeah, some of these trends will feature.
Okay, fair enough. Anil, a couple of questions now for you as well. But in particular, let me ask you this one first. Jay Shukla is saying, what about identifying small cap blockbusters, given that they are also today's large companies? How would one go about finding some of those gems in the stock market?
Sure. So, it's whenever you look at small cap, at least whenever I do look at any small cap, the first thing that you really do is look at businesses. You don't really go out looking for small caps or mid caps. You're basically looking for businesses which you think are going to grow and expand as the country's GDP expands. then you start looking into that particular company's management, that particular company's track record, and in particular, what really do they have, that the moat, the uniqueness, the strength, and then, kind of start building a small exposure and a position, and gradually over a few quarters and a few possibly years, generally build a large exposure. That's the way you really know into any particular stock. In a small cap, it is relatively under-researched, number one. Number two, as I mentioned, it's most important to get the business right, in the sense there has to be expansion of business possibility, because there are many small cap companies which are very niche, but they have limitations in terms of the business, in terms of how much can they expand. And if you can't do that beyond a point, as a fund manager, you can't take a meaningful exposure, right? Because the fund sizes keep growing, and that's the issue. So you really need to focus on a couple of things. The first, as I keep saying, is business and the possibility to expand that business over a period of time, and then of course the capability of that particular management to take it forward.
Okay, I have a couple of questions here from some viewers, and I wonder which one of you would like to take this. One question says that, you're talking about finding companies with a strong balance sheet, etc. But the fact that prices are already moving so high is a big risk, given that we still don't have a vaccine, etc. And we might actually continue to see retesting of lows in the market. How will mutual funds manage such an event? And then there is a question on a particular fund, the ABSL Pure Value Fund as well, which I'll get to in a moment. But which one of you would like to take this?
So the first part that you talked about is that about there being no vaccine and how, as a mutual fund, how do we look at it? See, yeah, obviously agreed. There is no vaccine at this point of time, and when a vaccine is going to come, we don't have a clue at this point of time. So, as I think that we hope that eventually, in the period of time, even if the vaccine doesn't come, an effective treatment comes, which will give confidence for people to come out into the public and start working. And especially if you go back to see, people have been talking of a 1.5 year to 2 year period, but especially all those people go back to the Spanish flu times and see how long did it take for everything to normalize. The Spanish flu played out for 2 years and suddenly it stopped. And it was a much more, or at least as far the numbers go, the fatality rate was significantly higher than what the current virus has. So that's the max outside that at present that you'd like to take. But we hope that it will be much lower, and gradually the treatment protocol and effective treatment will gradually come. And and these kind of things, especially when these are uncertain at this point of time, is especially important to invest in companies which suffer the least during the pandemic and will grow going forward. So these are companies that you'd like to own during a pandemic and also want to own after the pandemic is over. So, and typically these companies would have strong balance sheets, and apart from the characteristics that I said earlier, they especially also have strong balance sheets to withstand. So I think it doesn't change anything. We'll continue to hold this.
Also, just to add to this, as Satya rightly mentioned, things like these pandemics last for 1 or 2 years and then go away. But for a long-term investor, many a times this gives a very good opportunity, entry point into the markets. If you look at the last decade, we have seen GFC, global financial crisis, then you had taper tantrum, then you had peak crisis in the European markets. But each of these crises also bring with them an opportunity to invest into the markets at lower levels. So I think from a long-term investor perspective, such opportunities are the ones to capitalize upon.
All right. Ajay, lots of questions for you on the chemical sector, especially, also specialty chemicals is a sunrise sector, and one on telecom. A particular question coming in from Sholay saying you're overweight on chemicals and telecom. Do you start to see a payoff there?
So as I said, like, I'm not a believer of a sector. It is all about companies. And Probably there's one company which is from agrochemical space, agrochemical and seeds company. It is the largest agrochemical and seeds company globally. So that is where we have exposure across my schemes and across our fund house as well. And the company continues to do well. They saw acquisition, they saw a merger. In fact, they merged with the seed company, and merger benefits hopefully should seep in. So this is all about the chemicals, what you are talking about. Though I am not a chemical per se sector expert. On the telecom, I feel being an engineer, somewhat I have a bit of a contrary approach for the sector, anything to do with technology. So for me, there's nothing called a first mover advantage. So once a player comes in, there are so many people coming into the sector, and the sector gets commoditized. We saw it on Android side, how many players had come in on the mobile side. We saw Nokia, we saw Motorola, and we saw a lot many others, Gioni, and now Gioni is no longer there. So it is all about a basket of how it is packaged. So like Amazon is a great integrated company. So is one of the Indian companies trying to package the entire thing, entire basket of things into a one stop shop. So it is going to be all about that rather than a sector which is called telecom. And I have, though I'm watching the events very closely, but this COVID kind of event is going to, we need to visualize what happens to life after COVID. Vaccine is going to come in 3 months, 6 months, 9 months. It is going to happen across the globe. Scientists are working and it is going to be coming in. But the time horizon, we are not sure. So if the vaccine was to come in and say 3 months, then the portfolio positioning will be very different. And if it was to come in 6 months, portfolio positioning is going to be very different. But what is going to happen is like work from home culture has come up very well. TCS has said that was a public statement that 75% of the workforce is going to be working from home. Twitter, there was a tweet yesterday, I believe, that they are going to allow employees to work from home, whoever feels like. And so what we will discover is like companies are saving on the real estate cost. Employees are going to save on their travel costs, and that money is going to go somewhere. Probably the customer or the companies that were serving to some other company, probably those bills are going to reduce, or the selling price is going to reduce, or the margins are going to get recalibrated. But at the same time, we are going to see an increased pace of automation. And what some time back people were saying that 5G is not going to come, I feel that it is only going to accelerate the transition from 4G to 5G, where you will like to have faster speed and reliability on the data.
Anil, there's a compliment for you from somebody with an exposure to BSL equity, saying the clarity is very encouraging. So that's for you. Also, will you be able to answer this question on the hybrid 95? I get a couple of questions actually on the balance 95, and whether or not that's going to go through any kind of reshuffle.
So I think Satya would be the right person, since he's the one who's just taken over 95 a couple of weeks back. And he's already answered it, but you could please direct that question to Satya. I think it makes sense.
What exactly is the question?
There are a couple of questions all alluding to whether or not you're going to change the kind of mix that's currently in the fund.
See, obviously, See, if you look at the kind of the way I invest, see, I mainly prefer growth oriented investing. So that is the primary type of investing where I'm much more comfortable with. So obviously, over a period of time, the fund will reflect the style of investing that I'm comfortable with, but it'll be a gradual process. It's not as if it's going to change overnight, because see, the markets are not liquid and you just can't change your portfolio overnight, and you have to look at what the current price is and what are the market sentiments, etc. So a lot of things go into it, but obviously over a period of time it's going to reflect a more growth oriented kind of investing style, with a major portion of the investing in which will have more secular kind of growth. See, when I tell that growth kind of investing, I'm not telling that you shouldn't invest in a value fund, or I'm not telling that growth is a better way of managing a portfolio than value, or it's a better way than managing as momentum investing. So all these investings have proven themselves over a long period of time. So you can make a lot of money if you follow value. You can make a good amount of money if you follow growth or you follow momentum. So it's more about what I'm more comfortable with. So I'm more comfortable with growth. So gradually, the fund will be restructured to a growth-oriented style.
Okay, and just to follow up on that, is there a tenure by which it can be expected to outperform its peers or the benchmark?
See, I would like that over the next 1 year, we outperform the benchmark and our peers. So that will be our endeavor. So that over the next 1 to 2 years, we outperform our peers and the benchmark.
Okay. Now, the ABSL fund, which of you will be able to answer that? Because you've got a whole host of questions coming in on that.
Which one?
Sorry?
Which fund?
The ABSL Pure Value Fund.
Okay.
And the questions are largely ranging to whether or not it's going to recover anytime soon. And if one is already invested in it, is it really a case of money being stuck? I think it's a small cap fund.
See, if you look at it, Pure Value Fund, when it started, it was mainly focused on investing on small and medium, basically the mid-cap value space, mid-cap and small-cap value space. So, but what has happened over the last 2 to 3 years? See, initially when we did it around 4 or 5 years, it was doing quite nicely, but gradually over the last 3 years, both globally and in the local markets, in the Indian markets, so value went out of favor, and it was more growth across the markets, both abroad and India. And apart from value going out of favor, what happened is that even in the growth, there was a huge concentration on few stocks. If you look at the ratio of Nifty divided by Nifty returns divided by Nifty equal weighted, or if you do Nasdaq divided by Nasdaq equal weighted, you will see that the ratios are at all-time highs. They're almost as if these ratios were there when the tech bubble happened. So obviously, when these things happen when the markets are extremely narrow. And the expectation was that the markets will broaden going forward. And the markets had started broadening from the beginning of the calendar year, and they were gradually broadening over the next till March. And then the virus thing happened, and the markets further narrowed down sharply. So we think that going forward, the markets, as the virus thing stabilizes, the market will broaden. And we have made certain changes in the fund. So now the fund it still focuses on the value strategy, but the allocation has gradually shifted, and we have added more large caps than mid caps. So the allocation to large caps has gone up. Because the allocation to large caps has gone up, the fund is stabilized. In fact, the fund has done quite well during this pandemic period. In the last 2 months, when there was huge amount of volatility, the fund has actually done well, which is mainly due to the changes in the portfolio that have been done by the fund manager. So going forward, if you look at the portfolio looks quite nice and looks to be a tight, clean portfolio. And we think that if you stay invested for the next 2 to 3 years, the performance should come back.
Okay.
Adding to what Satya said, or generally as a house, we tend to be sticking to the label, basically. Like if it is pure value, we try to be on a value-oriented stocks. Or if it is an MNC fund, we try to be on the MNC side rather than get into the hybrid characteristics.
Sure. Anil, a few questions here now alluding to, if you had to choose your portfolio, banking, pharma, how much weightage would you give each, and others? And amongst the others, what would it be if there was one predominant theme, or even a couple of other sectors that you'd look at?
So I'll tell you what the fund today that I run, which is the BSL Equity Multi-Cap Fund, and that should give you an idea in terms of what the weightages are and what I like, because that's displaying exactly what I like. So healthcare as a vertical is about 15% weightage, 1/5, which includes pharmaceutical and healthcare, which is hospitals and pathology labs, etc. Banking and financial space continues to be in the region of about 30-32%. And I am quite largely overweight telecom. So these are the three large, overweight positions, which is, healthcare, telecom, and private banks. Most of the other positions are underweight to neutral. So, that should tell you a bit of a color. So, we are, from a question that you asked perspective, consumer as a sector, while it's a most evergreen sector and evergreen stocks in this country, the sector, unfortunately, the valuations continue to be extremely rich. As a fund manager, I kind of a more value focused on a value based fund management style. As Satya mentioned, he's more of a growth oriented. I'm more on the value side of the portfolio, on the fund side. And I pick more of the stocks which probably offer reasonable growth at reasonable valuations. That's my motto. And that's the way I've run the fund in the last 7.5 years that I've been with Birla Mutual.
Okay, great. Just a closing comment then. I'm also just running through the questions in case there's anything we've missed.
Sure.
But I think largely people also just want to understand where we're at with the entire COVID scenario, how this perhaps changes any investment decisions, given that it's a never before seen event and there's so much uncertainty. And, would equities continue to be a safe place, whether it's through SIPs or otherwise? So just a short closing comment from you on that. Ajay, let me take one from you.
So above my feel is like, though we may go up and down on the market side, that will depend on variety of factors. But at the same time, we are surely going through a transition phase. And we have seen in 2008 to year 2000, not many companies, even if the market was going down and a couple of companies were making a new high, or in fact, large caps were shrinking and the small caps were graduating to mid caps and large caps. So it is all about the companies. We need to have our six senses. We need to activate our six senses or reactivate our six senses and see what is happening on the ground, and ultimately what are the businesses that are shaping up and handling the transition very well. And those are the businesses one needs to be in. And these are going to be winners of the next decade. And they can be 10x, 20x, 30x. So there's no limit.
Great. Anil, let's get your view as well.
Yeah, so, completely clear on one thing, focus on companies and sectors where India can be and is, a global force to reckon with in terms of, where we could really make a march. So if you go back to early 2000s, we had IT. today, India is recognized all over the world for their software services. And, that's a sector which has grown and grown by leaps and bounds. And had you been invested in that point of time there, you would have at least done 10x to 20x of your investments. Similarly, when you come to pharmaceuticals, we are almost 60% of global market share in terms of generics. It's had a couple of difficult years in the last few, but it's not taking away the fact that India has a huge advantage in terms of offering the world globally qualitative and competitive pricing generics. So that's another space to really invest in. So keep looking. Chemicals could be another space where India, over the next 5-10 years, will start dominating. So look for places where, and be early there, then the 10x and 20x is really possible. So I think these are the sectors I would really look at to be long-term investor.
Okay. Vishal, closing comments from you?
Yeah, sure. So apart from chemicals and pharmaceuticals that Anil alluded to, I believe insurance space is also something that would be a prime beneficiary of something like this, which is COVID-19 situation. We have seen in the past in the US markets, for that matter, that after a cyclone, a lot more people want to go for cyclone insurance, for that matter, for their homes. Similarly, we believe that there could be increased demand for both personal insurance as well as general insurance as we move on. And today in Nifty, there is not a single insurance company present, but I would not be surprised over the next 2 years, insurance might actually be 10% of the Nifty index. So that's something that within financials, I would be bullish on.
Fantastic. And finally, Satya.
Yeah, so see at the end, what I would like to say is that see, there are this recession, the way I would classify it is as a event-driven recession. It's not as if it's a structural or cyclical recession. A structural or cyclical recessions are much more difficult to handle and take a long period of time to settle down and to come out of it. An event-driven recession is typically the smallest one, especially when you take care that it doesn't turn into a structural recession. So this being an event-driven recession, I think we will come out of it if the appropriate measures are taken by the authorities, which I think will be taken. So and to add to that, see, it's difficult to say where is the peak, where is the bottom, and all that, and trying to time the market. But definitely, one thing is sure is that when there is a significant deviation from the trend, especially when there is a significant deviation from the trend towards on the downside, and especially when it is what has happened now, and that is when it's an extremely good period of time to invest in equities. And recessions, if you invest in the time of recessions in equity, typically you tend to end up with significantly higher returns than the average.
Fabulous. It was great speaking with all of you, and I'm glad that your viewers got a chance to really ask you some of these questions up front, and a clear message coming through, which I think has been greatly appreciated. So thank you so much for all of your time.
Thank you so much. Thank you. Thank you. Stay safe.
You too.
Thank you.
Thank you. Bye-bye.
Well, thank you, gentlemen, for those great insights. And thank you, Abha, for moderating a fantastic panel. Well, ladies and gentlemen, this brings us to the close of day 2 of the digital edition of Aditya Birla Sun Life Mutual Fund presents Voyage 2020, Navigating to a Better Tomorrow, partnered by ET Now. But before we wind up, I'd like to invite the Head of Sales Alternate Assets at Aditya Birla Sun Life AMC, Vikram Advani, to share the key takeaways from today's session. So with that, it's over to you, Vikram.
Thanks, Sumit. A very good evening, everyone. We had extremely enriching sessions today. We had the pleasure of listening to a very special guest, Dr. Talib, all the way from the US on COVID-19, neither being a black swan or a white swan event. And of course, we took a deep dive into our portfolio strategies post the COVID era, key sectors in this special situation, and the art and science of stock picking, very well articulated by our CIO, Mahesh Patil, and his large team of fund managers and analysts, Anil Shah, Satya, Ajay, Vishal, both the Dhawals, and Chanchal. I think a common theme across the sessions that we saw today was that while we are witnessing a crisis, there are opportunities in certain segments, and companies that will be more adaptive will succeed. And one should use the fall in the market to add further allocations in a staggered manner. Dr. Talib did mention that he believes that the crisis is an overreaction. Recessions are a good opportunity to invest. And of course, he believes that companies will adapt to new ways of doing business, and robust businesses will continue to grow thus investment in businesses that will remain robust will continue to grow faster than others. Diversification across asset classes is important, and he also emphasized the importance of hedging risk for combating both disinflation and hyperinflation. Mr. Talib further said that it's better to allocate your money later than it is too early. If you want to invest, say, let's say 20% of your money in markets, invest 12% and keep 8%. So when you find something interesting, you can invest the balance. Moving on, we had a long session with our investments team. Mahesh started off by conveying that while the economy activity has come to a standstill, and the global growth may look like -3 to -4%, and India at -1 to -3%, global economies have come together to fight COVID-19 by announcing a fiscal stimulus of 10 to 12% of GDP. As a reaction, Indian markets did recover in the month of April from its bottom in March. We also saw announcements from the Prime Minister and the Finance Minister over the last 2 days on a package of 20 lakh crores, which is 10% of the GDP. Mahesh also said that he believes that growth is likely to start picking up in the second half of FY21. Structural changes and new themes will throw out opportunities in certain sectors and stocks. Many changes are likely to become a new normal, like work from home and increasing the demand for consumer goods. Companies adapting digital ways of conducting businesses will be out of the woods faster. Several global companies are seeking to move manufacturing out of China, which gives a great opportunity for India, especially in sectors like chemicals, textiles, consumer goods, electronics, and pharma. In the current scenario, companies with stronger balance sheets, stronger brands, low leverage have better chances of surviving. So while investors might experience volatility in the near term, however, over a long term, one can expect good returns. From a valuation perspective, it is a good time to increase equity allocation. Mahesh also spoke about our investment process, and we have strengthened the same by going beyond numbers and diving into a company's narrative. Mahesh also suggested a higher allocation of 75% towards large cap funds like Aditya Birla Sun Life Frontline Equity and Focused Equity Fund, and multi-cap funds like Aditya Birla Sun Life Equity Fund and Equity Advantage Fund, and a 25% allocation in small and mid-cap funds like Aditya Birla Small Cap and Mid-Cap, and thematic funds like Gen Next Fund, the Pharma and Healthcare Fund, Banking and Financial Services, and the MNC Fund. Then we moved on, where our investments team spoke to us on key sectors of pharma, financials, and consumer discretionary. Our investments team mentioned that pharma has grown from $9 billion to $38 billion since 2008. COVID-19 has proved an impetus and may add to growth of the sector to become a $100 billion industry by 2030. Healthcare is also a great opportunity to improve infrastructure. In the NBFC sector, companies with a strong parentage and a strong corporate governance should come back fairly well, and post-COVID, digitalization in the sector will play a bigger role. Retail insurance penetration is also expected to compound post-COVID. As far as consumers is concerned, the packaged food demand is likely to grow. Quick service restaurants will evolve. Personal hygiene will be strong, and we'll see improved demand. Digital is here to stay in retail, and it's going to be a business necessity. Consumer durables still has low penetration in India, owing to which it will keep growing as demand for kitchen automation, house automation, ACs, washing machines, etc., is likely to increase. Finally, we had an extremely interesting session on the art and science of stock picking by our senior fund managers. Our senior fund managers reiterated Mahesh's point that companies with stronger balance sheets, stronger brands, and stronger cost management will perform better. The recent fall in the market is an opportunity to add staggered allocations. Vishal from our PMS team also mentioned that PMS can definitely complement mutual fund allocations as they are benchmark agnostic and concentrated, and investing in the science of exclusion by using screeners and an art of inclusion. Have a very, and we look forward in seeing you tomorrow. Over to you, Sumit.
Fantastic. Thank you so much, Vikram, for that. Well, ladies and gentlemen, that's all for today. But do remember to join us tomorrow at 3:30 p.m. for the final day of the 7th edition of Voyage 2020. We'll be starting with an address by the Chief Economic Advisor of India, Mr. Krishnamurthy Subramanian. So you definitely don't want to miss that. Now, today we saw the equity outlook. Tomorrow, the focus will be on fixed income, and we'll have the brains behind the fixed income investment portfolio of Aditya Birla Sun Life AMC joining us. We'll hear from one of India's most renowned nutritionist and health coach, Luke Coutinho, and we'll close the conference discussing something that this lockdown has made us realize: the importance of mindfulness and mental well-being. And we will be joined by Sadhguru Jaggi Vasudev for the same. So it looks like quite a power-packed session tomorrow, and you wouldn't want to miss even a minute of it. Until then, please keep your thoughts, suggestions, and comments. Let them keep coming in with the hashtag Voyage 2020. Do tag us at @ABCABSLMF. Before you go, here's a quick look at this short AV that takes a look at the efforts that's been done, or the contribution that the Aditya Birla Group has done to the PM Cares Fund that is helping all of us in this battle against coronavirus. Thank you so much for joining in. We'll see you tomorrow. Stay safe.
जॉर्ज, लेट्स प्ले वन वर्ड आंसर्स ओनली, ओके?
ओके।
आपको अपने एसआईपी से क्या चाहिए?
फार्म हाउस।
कब?
2030।
लॉन्ग टर्म सोच, नाइस। और शॉर्ट टर्म में?
हॉलीडे।
कहाँ?
जापान।
कब?
नाउ।
बस, दैट्स ऑल।
गाड़ी।
वो तो है
बड़ी।
मतलब लॉन्ग टर्म और शॉर्ट टर्म में जो भी चाहिए सब एक एसआईपी से मिलेगा। यू नीड अ म्यूचुअल फंड पोर्टफोलियो। हर लॉन्ग टर्म सपने के लिए एक एसआईपी इक्विटी फंड में, हर शॉर्ट टर्म सपने के लिए एक एसआईपी डेट फंड में। Aditya Birla Sun Life Mutual Fund Investor Education. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Hitesh, what's up?
Up, nahi down. Investment.
Investments और life में क्या common है?
कभी गाड़ी बंद, कभी full speed. Sometimes you're lucky. Sometimes unlucky. कभी high, कभी low. कभी win, कभी lose. It's okay. Ups and downs होते हैं. Life है.
लोग लाइफ से नहीं डरते तो इन्वेस्टमेंट से क्यों?
हाँ, ये तो सोचा ही नहीं था.
अप हो या डाउन, SIP है. मार्केट डाउन तो यू गेट ज्यादा यूनिट्स और अप तो ज्यादा वैल्यू पर यूनिट. लाइफ या म्यूचुअल फंड्स, जीत के लिए डटे रहो. आदित्य बिरला सन लाइफ म्यूचुअल फंड इन्वेस्टर एजुकेशन. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.